Good morning, everyone. The time is now 9 a.m. CE time. My name is Torben Johansen, Chairman of Danish Accounting Standard Committee, set up by the FSR Danish Auditors. And on behalf of the Confederation of Danish Industry and FSR Danish Auditors, I welcome you all here to this EFRAG IASB outreach on EFS disclosure requirements, where we are going to have a discussion and a debate on two exposure drafts. The one is the disclosure requirement in EFS standard, a pilot approach, and the other one is the exposure draft on disclosures for subsidiaries. Thank you to the members from IASB and EFRAG, and also thank you to EFRAG for technically hosting this event. The moderators for this event today will be Jan-Peter Larsen from EY and Kristian Koktvedgaard from Confederation of Danish Industries. And for further introduction to the day, I will hand it over to Kristian.
Thank you very much, Torben, and also very warm welcome from my side. First of all, I have to apologize for the lighting. We're sitting with lighting in the back, and that is, of course, a little bit unfortunate, but I hope that you're able to see us here. I think we are very fortunate today. We have a strong panel here in Copenhagen with Tina Aggerholm, former head of accounting in Carlsberg, IFRS expert. We have Thomas Ryttersgaard, now at AP Moller Mærsk, technical accounting. We have Tang Lassen, auditor from EY. No, PwC. Sorry, first mistake. But then again, 2 or 3 letters, I think it makes a lot of a difference for you. But I think we are very fortunate to have you here, Kim. And the reason maybe for me confusing the letters is my co-host, Jan-Peter Larsen. And I hope you are with the EY.
Well, I was yesterday, so I think I'm also today. But I have
absolutely
32 years with Deloitte, so I still have to practice to say EY.
Yes, you have a legacy with Deloitte, but you are with the EY now. So very strong panel here in Copenhagen, but I think we're even more fortunate to have very strong representation, both from IASB side and from the EFRAG side. Before handing over for a brief introduction for the IASB and EFRAG, I would like to launch the first polling. And before we do that, I have to say that the people in Copenhagen have to activate the telephones before we can launch the voting or the polling. And while you try to feed in the background, I'll first hand over to the IASB side, which is led by board member Bruce Mackenzie. So if you could, from the IASB side, just give a very brief introduction on who we are today.
Thanks very much, and thanks for inviting us to be part of this event today. My name is Bruce Mackenzie. As was said, I joined the board in October last year. And it's a great opportunity just to kind of share with us a couple of the key projects we've got. There are the 2 projects we're talking about. First one we're going to be talking about is the Targeted Standards Level Review, and Kathryn is joining us to talk a lot about that. And then we've also got Michelle, who will be talking to us about the subsidiaries project with no public accountability. So 2 very key projects that are going to kind of take us through the to see how financial reporting changes in the near term. So that's who we've got. And we've also got Carla on side as well from the subsidiaries team who's online. So thank you very much again.
Thank you very much, Bruce. And an equally strong representation coming in from EFRAG, led by Chiara del Prete, tech chair or chairwoman. So Chiara, who have you brought with you today from the EFRAG side?
Good morning to all of you. A warm welcome also from my side on behalf of EFRAG. And it's a pleasure today to join forces with the Confederation of Danish Industry and the Danish auditors and the IASB for another outreach event with Danish stakeholders. And we may say that we have a tradition of successful online events with you. Thank you very much in advance for the input you will provide. Today with me, I have a number of colleagues, Kathryn Schöne, our project director, Almudena Alcalá, Fredré Ferreira, and who else? Felipe Alves, and I think that's it. So thank you very much again, and I hope you enjoy this event.
Thank you very much, Chiara. And we're really looking forward to this event today. And yes, we have had previous events before with the online meetings. I think today is the first time where we try a hybrid. So we have a number of people here in the room in Copenhagen, and hopefully it works well. I think definitely in terms of dialogue, I'm looking forward and I'm going to appreciate the fact that people are a little bit more together. I think that would be able to stimulate the dialogue. If we turn just back to the results of the polling to see who we are, because we have also a fairly large online audience here. I would say roughly a third is with preparer background, and also roughly a third of the accountancy profession. And then we have some good representation as well from professional organizations, academics, and regulators. And then I'm not sure what the other covers, but I think we have a fairly broad, maybe a little bit more on the user side would be beneficial, but since the disclosures essentially at the end of the day is to cater for the users of the financial statements, I think it's worthwhile having them in the back of the mind. With that, I think we turn to the first order on the agenda, which is the disclosure requirements in the IFRS standards. And I will pass the floor to IASB, who will take us through a presentation on what this project is all about. So the floor is yours.
Thank you very much, and good morning, everybody. It is a great pleasure to be here to talk about my favourite topic, which is the IASB's recent exposure draft, Disclosure Requirements in IFRS Standards, a Pilot Approach. So in the slide pack for today, what I'm going to do in the next 20 minutes or so is first talk a little bit about the problem that the IASB is trying to address with this project, always really important to keep in mind. And I will then talk through the board's approach to addressing that problem and what happened when the board applied its approach to a couple of test standards. I'll keep it quite brief and stick to key points, but I will, of course, be very, very happy to answer any questions on the detail later in the session. So I'm going to start with talking about the problem. So I'm looking at slide 7 in the pack, where we sum up what we have long-termed the disclosure problem. And the IASB has heard over many years that there are essentially 3 things that are problematic with disclosures in financial statements. Firstly, a lack of relevant information that users of financial statements need. Secondly, too much irrelevant information, or what many call boilerplate information. And thirdly, ineffective communication of the information that is provided. Because even if the right information is there, if a user can't understand it, then it isn't doing its job. So moving on to the next slide, over the years, the IASB has done a huge amount of research about why this disclosure problem happens. Why aren't the notes to financial statements as useful as they might be? And there's a lot to this, but if I could sum up the most critical aspect, it's really all about the application of materiality. Or put another way, companies, auditors, many stakeholders taking what I might call a checklist approach to financial statement disclosures. So I think most people are familiar with the fact that IAS 1 requires a company to apply materiality across all of its financial statements. So in applying the lists of prescriptive disclosure requirements in an individual standard, a company is also required to think about, well, are these items material in their own right? If something additional is material, it needs to be disclosed. And if something isn't material, it does not need to be disclosed. And that materiality overlay is incredibly important to making sure that financial statements focus concisely on the information that is really relevant. What we've heard over the years, however, is that companies face a lot of practical barriers to being able to apply those good materiality judgments. You can see some of those on the slide, and I will come back to them when I talk about the board's new approach. What we've also heard is that from the perspective of many stakeholders, the best contribution that the board could make to improving the problems with the notes is to take steps at an individual IFRS standard level to give companies what they need to be able to improve their disclosure and get past these practical barriers that I mentioned. But looking at slide 9, this is not something that the board can do it on its own. It's not the case that it could change disclosure requirements in the standards and magically disclosure would be perfect. Instead, anything the board does here would be a first step in every person who is involved in financial reporting playing their part in improving disclosures. We've all got to work together if this is to be achieved. So the board is viewing this project very much as a catalyst for positive change. So slide 10 summarises the approach the board has taken to this project, which is worth laying out before I get into the proposals in the exposure draft. So what the board has done is listen to all of that feedback about why disclosures in financial statements are not as useful as they might be and how the standards contribute to that. And the board has developed a whole new approach both to developing the content of disclosure requirements in the standards and how it writes those requirements. The board has laid out that approach in what we call the guidance for the board, which is a whole new way for the board to do things. Now, as you'll see over the next few slides, this would be a very different way of doing things for everyone. And so it was really important that the board test that out properly. So they then picked 2 IFRS standards, being IFRS 13 on fair value measurement and IAS 19 on employee benefits, applied the new approach to it and developed proposed new disclosure sections for those 2 standards. The board has now laid out both the guidance for the board and those 2 sets of proposed new disclosure requirements in an exposure draft, which will allow all stakeholders to see exactly what this would look like if the board were to apply it going forward in its future standard setting and provide comments to us about whether it would achieve the benefits intended and how else the board could improve things. Now, the final thing you'll note on this slide is that this project is responsible for, to my knowledge, the longest comment period the board has ever given. And that is a demonstration of the potential significance of the change that could be brought about by this project. So feedback here is really essential. So after I've summed up the proposals in the ED, I will highlight the things that we are looking for from you in terms of input. So moving on then to talk first about the guidance for the board, so that proposed new approach. Now, there's a lot to this, but I would say there are 3 really key factors that are the important ones to highlight. The first thing the board has proposed is in response to the fact that companies have told us today they get these long lists of required disclosures, but they don't understand what the point of them is, what users will do with the information. And if that is the case, then with the best will in the world, it is really difficult for a company to apply a good materiality judgment. If you don't know why something is useful, how can you judge whether it's useful in your case specifically? So the first big aspect of the proposed new approach is the board spending time with users of financial statements one-to-one to interrogate their information needs in depth, looking at not just what information they want, but why they want it, what they are looking to do with it in a practical sense, how detailed it needs to be, all manner of things to fully understand what it is that users are looking for. Importantly, the board would then look to explain all of that in detail right there in the standards so that companies have everything they need in terms of understanding what users are looking for to help them with those materiality judgments. The second key point, moving on to the next slide, is all about how those user needs would be reflected in the disclosure section of an IFRS standard. And what the board proposes to do is to develop detailed and specific disclosure objectives that require a company to disclose information that would enable the user need in question to be met. So those disclosure objectives would take two forms. The first is what we call an overall disclosure objective for a topic, which would summarise the overall user information needs. So, for example, with fair value measurement, the overall user need is really all about understanding exposure to uncertainty. And that overall disclosure objective would provide context for the detail that follows and also prompt an entity at an individual standard level to perform that check of, well, if I've followed all the detail that follows, have I really met the big picture user need? Is there anything I need to change or add to get there? We also have what we call specific disclosure objectives, and it's all in the name. These are very specific. There will be several of them for each topic. So, for example, in the proposals about defined benefit pension plans, there are 6 specific disclosure objectives, each of them explaining a very specific user need about defined benefit plans and going on to explain what users would do with any information they get in response to that objective so that companies can really understand what users are looking for here. Again, those specific objectives would require companies to disclose information to enable the explained user need to be met. And really, the big picture purpose with all of these objectives is to clearly place the compliance bar on meeting user needs rather than providing particular pieces of information. So addressing that perception that the easiest thing to do today is to treat the requirements like a checklist. The third key proposal is very related to that. So moving on to slide 14, it's all about items of information and how they are used in the proposals. So each of the specific disclosure objectives that I mentioned would be followed by a list of items of information that might be used to meet that objective. Now, importantly, and unlike today, the majority of those items would explicitly not be mandatory. They would be there to help companies fully understand the objectives and what the board was getting at, generate ideas about how they might meet those objectives, but they would be clearly written in the standards as not mandatory. There are a few exceptions to that. When the board decides that a particular required objective could not be met in the absence of a particular piece of information, those items of information would be mandatorily required. But across both of our test cases, there are few examples of that, because in most cases, judgment really is required to disclose what is most relevant in an individual case. So again, this third proposal is all about moving away from that perception that you have to tick down a checklist and making very clear that the requirement is to meet user needs. If I put that another way, it makes providing the best possible information to investors the same goal as achieving compliance with the requirements. Now, slide 15 lays out the various ways in which the board has provided tools to help companies apply the judgment that would be needed to meet disclosure requirements framed in this way. We often get the question, well, if the underlying problem is that materiality judgments are not being performed brilliantly today, how can the board move to an approach where that judgment becomes even more critical? And the answer is, well, firstly, the judgment is already required. And secondly, the board has not just moved that compliance bar, it has also given companies, auditors, regulators, everyone, loads more tools to work with in making the necessary judgments. The detailed objectives, the explanations of what users would do with the information, the items of information, illustrative examples and application guidance where it's needed. So there's loads to work with there, and the board's view is that the proposals are detailed enough, explain user needs well enough, that companies will have everything they need to focus their disclosures on what's relevant and make their notes really useful. But as said, feedback is critical here, and it is super important that we hear from stakeholders about whether the proposals really do achieve that. So moving on to the next section, the board has applied all of this to two examples to lay out exactly what it would look like if applied in future, so that you can see exactly how detailed the objectives are and whether they give you what you need. So the first example is IFRS 13. Now, with fair value measurement, I would say that when we did those detailed conversations with investors, what we heard was that today's problems are all about the application of materiality. Investors consistently tell us that they feel today they often get loads of information about fair value measurements that they think are immaterial, and that information therefore is not useful to them. At the same time, they might look at a breakdown of the fair value measurements that a company has and see that there are some really material items in there that they maybe don't understand from a one-line description, want more information about, but aren't getting it. So it's not so much that the information disclosed about fair value measurements is technically not the best information. It's more about making sure it is given about the correct population of items. At the same time, companies agree that those detailed disclosures are onerous to prepare, and they too would really prefer to be focusing on what is relevant and material. So the board's proposals respond to all of that in several ways, most notably by developing those objectives to give companies a basis for making those judgments and help them focus on what's relevant. The proposals also largely move away from this idea that is very prevalent today, that companies feel they have to disclose loads of information about level 3 fair value measurements, irrespective of materiality, and often disclose next to nothing about the rest, even in those circumstances where you might say have something at the level 3 end of level 2 with a degree of uncertainty, something very material. Users want to know about that. What they care about here is exposure to uncertainty. So that's a very high level overview of what the board has done on fair value measurement, but again, very happy to take questions later if more detail would be helpful. Now, looking at the other example, which is IAS 19 or employee benefits, the situation here is very different. And in fact, one of the reasons why the board felt this pairing of test cases was valuable is because it does test the guidance for the board in different ways. Because with IAS 19, what we heard is that there are issues with the relevance of information and with the effectiveness of communication. So thinking about defined benefit plans, the two most prevalent pieces of feedback we heard from investors were firstly that the thing they care about most is the cash flow effects of defined benefit plans, and they don't feel they get much information about that today. Secondly, we heard an awful lot that investors feel that the defined benefit pension note is just impossible to understand, to the extent where sometimes they struggle to understand, well, what is the net liability position here? So there are some real potential improvements to the relevance and communication that is typically coming through these notes. At the same time, companies, again, feel that these notes are onerous to prepare, and they actually have consistently said to us they completely understand why investors are interested in the likely cash flow effects of a defined benefit scheme, and they agree that that would be more useful than some of the information they give today. So putting the feedback from companies and investors together, there is the potential for real benefit here to get more relevant disclosure that represents how company management and trustees think about pension schemes and think about their future cash obligations, and that would potentially take away some onerous preparation time too. So with IAS 19, the board has again come up with specific disclosure objectives that flush out all different aspects of the user needs that have been identified as really important. So the two that I've mentioned on cash flows and good communication of amounts in the primary financial statements. There are other things. So for example, the board has developed objectives looking at measurement uncertainty and highlighting what the user need is there, and the fact that companies could think about different ways of meeting that need that might perhaps be simpler than the detailed assumption by assumption sensitivity analysis you get today. There's also an objective about the length of time payments may need to be made out on a closed scheme, which is a very prevalent issue at the moment. So those objectives are again really intended to give companies what they need to understand what's most important to users and focus their disclosures accordingly. Now, the final thing I will say before I hand over is about the input that we are looking for from companies on all of this. So moving forward to slide 20, I won't read all of this out, but essentially what I hope you've taken from this overview is that there is a potentially really significant change here. And even if you are sitting in the audience and for you, employee benefits and fair value measurements are maybe not the most significant thing in your financial statements, what the board is doing with those two standards is testing out an approach that it is proposing to use going forward. This whole idea about objectives, about giving companies the tools they need to apply good judgment, there is potential for that to be used more broadly. All the evidence we have says that that would be very beneficial in helping the quality of disclosures in financial statements and indeed allowing companies, auditors, regulators to spend time discussing the right things, the material things, instead of focusing on that checklist and things that are potentially not so significant. But the board can't get there on its own. What we need is to hear from every stakeholder type what you think of these proposals. Do the objectives in the two test standards give you enough to work with to make those good judgments and identify what's material? Would they have any cost consequences that the board might not have thought of yet? Would they lead to better, more relevant information? Would they give auditors and regulators everything they need to challenge the judgments that a company has made and have meaningful conversations about the stuff that really matters? So there's loads of feedback we're looking for here. So we are really interested to hear from the panel and the audience today. Very happy to answer any questions you have. But with that, I will hand over to the next speaker.
Good morning, everybody. Thank you, Kathryn, for that very detailed but still on a high level summary of the new approach by the board. I also want to congratulate Denmark on being the first hybrid event that we have from an EFRAG perspective, so leading the way here. So if I get back to the project, the overall approach, I think it is important to note that EFRAG supports the IASB's new attempt at creating a more rigorous approach to improve the relevance of disclosures. We think it is really important and a good thing that we are trying to replace the reliance on checklists, which often result in boilerplate disclosures, with an approach that is more focused on the usefulness of the disclosures. We do note, however, the challenges around the application of materiality, especially in the context of disclosures and then sub disclosures in the notes, etc. And we also have some questions about how this fit in with digitalization, where you almost need more companies doing the same, which seems to be the opposite direction as what is required to create more relevant disclosures. If we then talk about the field testing that Kathryn was referring to on slide 22, I do want to state that we have several companies that have indicated their willingness to help us in this regard, and we are extremely grateful to all entities across the globe, but particularly in Europe, that are helping us to do the testing to see how these proposals will work. We've also had some feedback in the last week that at least some of the participants have found it really useful to look at their old disclosures again with some new eyes in a certain way. And I'd like to think that also the interactions with ourselves and the IASB has helped them to challenge the way that they look at their disclosures and whether they really provide the useful information to users. As noted in our draft comment letter, we also hope that field testing will help us understand the cost-benefit analysis and whether it is necessary to have a minimum set of requirements. Now, this is not the way that the IASB had decided to go, but this is just something that we thought was important to consider. However, I think we do notice through the feedback we have received from participants so far, and it's not that much yet, that often people tell us nothing will change, and so therefore the whole concern that we might need some minimum requirements may not be that big a deal. The last thing I want to emphasize that we're already hearing through the field testing as well, and Kathryn had touched on that as well in her discussion, is how crucial the role of auditors and regulators are in this culture change. It's very difficult for companies to start thinking about how to do their disclosures differently if they have concerns that all these items of disclosure that the board is putting on a non-mandatory basis in the statements, in the standards, if auditors and regulators treat those as just a different way of dealing with a checklist. So we will need change across the board. So the one thing that we think is really important for the field testing, if we go to the next slide, is involving small and medium-sized entities. As I said, we are really grateful to the bigger companies that have indicated their willingness to help in this regard. But if anybody is happy to give an interview to ourselves and the IASB on these topics, i.e. without doing necessarily the mock disclosures, you are more than welcome to contact us on that email address. We are also in the process of creating a short survey or questionnaire where we will be targeting small and medium-sized entities to make sure that we get their input, because we are concerned how they will cope with these requirements, given that they probably have less resources than some of the bigger companies. If we go to the next slide, I just wanted to give you here an overview of where we are and when you can expect some action or to hear a bit about the field testing. So at the moment, we are in the field test completion. The participants have been requested to give us their feedback by the end of October, the 25th of October to be precise, so less than 3 weeks away. And then after that, we will work through the responses, both the mock disclosures as well as the questionnaire they filled in about how they experienced applying these standards for the first time. And then we will organize some workshops with various participants and also with other stakeholders like regulators and auditors. And then the idea will be to have to let you all know about what we found. So we're trying to drill down a bit in the field testing results. So that's it on the feedback that we're busy with. So if I go to slide 25 and IS 19, I think here again, I just want to pick up a couple of points. We agree with the overall disclosure objective. As I've mentioned before, the cost-benefit analysis will ultimately depend on what we hear in the field test. At this stage, we are unable to say anything. We do have some concerns about the changes around the sensitivity analysis that is currently required. We have been told that this is really useful, and we are concerned that this will no longer be required. So your thoughts on this would be really, really useful to us. If I then move lastly to IFRS 13, here we agree with the mandatory items and the overall objective as set out by the IASB in their proposals. However, I personally have some concerns around the sensitivity analysis as currently required by IFRS 13, and then this new term that we have, alternative fair values. I find it quite interesting that how people seem to interpret this. They seem to think of it as more an IFRS 7 type of market risk disclosure, i.e. if circumstances were different, would I get a different answer? Whereas I think under IFRS 13, what the board is aiming at is more measurement uncertainty. And what do we mean by that? It is that you can have three valuers valuing the same thing, be it a property, a derivative, whatever, and they might have different answers. And what you're trying to do with these type of disclosures is understanding that range in which people could value this item. So it's not if I have a different scenario, would I get to a different answer? It's just if I have a different valuer, will I get to a different answer? Then the last thing I just think is quite interesting and something to think about is how will we deal with comparatives in the new model? So every year we are focusing on those aspects that are most material and most important to the entity. But that can change from year to year. So next year, do we just reflect what we reflect in that we focused on in our comparative period, or do we provide comparatives for the information that we now regard as material? So it's not a big deal, but it is just quite important to understand how that will work to make sure that users get useful information, but also that preparers and auditors know what is required. So with that, I hand over to the panel. Thank you very much.
Thank you very much for that extensive presentation. Before giving the floor to the first panelist, I would just like to remind the audience that you are able to pose questions in the chat function. We will then take them as we go. There will also be a little bit of time at the end of this session to allow for questions from the audience. But please make use of the chat if you have something, a question or comment that you think is important. With that, I will turn to the first in our panel, Thomas Ryttersgaard from Mærsk. And maybe, I mean, what are your initial reactions to this proposal? Is it helpful from your side?
Yeah. First, I want to thank FSR, IASB, and EFRAG for giving us this opportunity to comment on this quite early in the process. When I'm looking at this approach, I must say I really appreciated this assessment of the disclosure objectives. I think is something that has lacked in many of the standards that has been developed over the years, and that has caused a lack of an underlying principle has caused quite a big variety in the disclosure requirements in individual standards. Some of them are easier to work with than others. And from my perspective, of course, the less disclosure requirements, the easier it is to work with. But nevertheless, this checklist approach to providing disclosures in the annual reports has been driven by this lack of disclosure objectives. I know it's something that IASB has been working on for quite some years with the practice statement on disclosure materiality altogether. But I don't think we're quite there yet. The thing is that when we talk about materiality in accounting, most of it is derived from the auditor approach, where they have quite a well-developed set of tools to assess materiality, but it's limited to recognition and measurement. What we have when we talk about materiality regarding disclosures, we don't have the same experience as a group. That means both us as preparers, but also the auditors. And this materiality assessment needs to be better developed in order for us to be able to work with this. So the disclosure objective thing is a good step in the right direction, because it gives us some concepts to hinge our disclosure argument on when we decide whether disclosure is material or not. It helps us move away from this very quantitative approach to materiality, also when it comes to disclosures, and helps us with some qualitative requirements, qualitative materiality criteria that we can use in the argument. However, I am still quite uncertain as to what this would require from us. EFRAG mentions the mock-up disclosures. That is really something we would like to see in order to get a better feeling of what is expected from us. Furthermore, we will need to have discussions with auditors and especially the enforcement agencies, because they will also be missing this checklist that they can use when they assess whether the disclosures are proper or not. When it comes to materiality, a big question is whether something is material or not. That means it should make a difference for a potential or current investor, analyst, etc. But is it just one person that needs this information? Is it a wider group of people who needs this information in order to make it material? Because the underlying problem we have is that if it's required by just one person and we are then forced to provide a piece of information, then we will not change that much, even though I fully agree with this disclosure problem issue, which has many different forms and shapes.
Thank you very much. I think you teed up a number of concerns, but I also took note of the fact that you appreciate the approach, that it is helpful. But then I suppose when you start scratching a little bit, some of the concerns arises to the surface. And one of the people who usually are looking for concerns of scratching in the surface, I think that's in the DNA of an auditor. Kim, what is your opinion or initial take on the proposal?
I think, first of all, let me start or repeat what Thomas said. Thankful for being able to have this event and discussing this, and also to repeat that I welcome the approach. I welcome the objectives. It gives us something to work with. But of course, with new ideas, new thinking, there's always concerns. We know what we have. What are we going to have in the future, and how will it actually work in practice? With the objectives, I would say that in several years we have discussed and argued that it would be nice if someone could tell us in the standard what are the objectives behind a given disclosure. Because if we know what the objective behind a given disclosure is, it's easier for us as auditors and also for the preparers to find out what information actually to include in the financial statement. As Thomas said, what is materiality? Materiality, is it towards one investor, one reader, or towards 100 readers, or who are we actually talking about when we are sitting down preparing this in that situation? So I welcome the approach. I welcome that we are having the discussion. Are we there yet? No, I don't think we are, but we are working in the right direction. Currently, it is going the right way. One of my concerns with the project as it is that I think that we have a lot of disclosures in the standards. And as Thomas also said, the old standards include 2 or 3 disclosures. The newer standards includes 100s or 200s or 500s disclosures. So depending on when the standard was developed, more and more disclosure requirements are included in the standards. That's also why we have actually said earlier to the IASB, please look into the standards, find out if all 3,500 disclosure requirements is actually needed. So one of my concerns when reading this is that when I look at the list of non-mandatory requirements, it looks a lot like the old requirements in the standard. For example, you took the approach in IAS 19 said that what investors would actually like to know something about was the cash flow. Okay, there is one objective around the cash flows, but there is 7 other objectives in there. Why are those 7 objectives important? Is it because we had some information before that we are not willing to get rid of? Or is it because I don't fully understand why all those disclosures are actually needed in that situation? So again, I think we need to explain even more. I know you have really tried in this situation, but I think we need to explain even more why are those disclosures important for the investors. It is the key in this approach. It is to understand why is the information important, because you can always find an investor that just wants more information. That's easy. I can go out to the street and I can find one, pull him in here now, and he will just say, please give us all the information that I can get from the company. But we need to have a bar somewhere. We need to find out where to put that bar, both as a preparers, as an auditors, as a regulator, to be able to see this or get it to work in the future. So yes, I have some concerns, but I think we are moving in fully in the right direction, and we're working the way that we should work currently.
Thank you, Kim, and you touch as well on the point in terms of the beneficial of the objective, but also highlight some of the issues around the users and definition of users. But also, I think you said challenge a little bit on how firm are we on setting the objectives. Is that clear enough? And the link from the objective to the disclosure requirements in the current proposals. Tina, I mean, you have the benefit, but also the challenge of being the final one in the first round here. So probably some of your points are taken, but your initial reactions to this?
Thank you, Kristian, and also thank you from my side to EFRAG and IASB to join us in this meeting. And yes, as you said, it is a challenge to be the last one. So maybe just to build on what has already been said by the 2 first comments, and to your point and what you discussed in whether the objectives are clear enough. What I could be afraid of as a preparer is that we are now trying to add a lot of guidance on objectives, and that each of the disclosure notes should start by addressing what is the objective, how does the company work with this specific area, what are the reasons, and what are the, let me broadly call it, policies behind how they act and what they do, which is in addition to what we do today. generally, I really like that. But what I am afraid of is that we are now adding lots of additional disclosures that will be somewhat generic year on year. Because if you look across a lot of the areas, it is the same way of dealing with these things every year. So the risk is that we will add really useful information, but it will only be useful in year one, at least to the user that follows the company. And it will be then seen as more and more redundant as the same user come back and go through the annual report for the same company year on year. So we need to find a balance on how do we provide these information on the objectives in a way that are useful every year, and then at the same time take out some of the very, very detailed typically tables that we have today and make then those the redundant information. And I'm not sure we are quite there yet with the standard. I totally agree we are moving in the right direction, but I think we need to help one another. And how do we make this useful every year in a new way of describing it and take out some of the information we have today so we are not just clouding the financial statements even more than what they are already. One of the things that might be more helpful is if we try to make some guidance, and that could both be in describing the objectives, but it could also be linked to each of the very, very long list of possible informations to provide in the disclosure notes on whether things should be or should be considered in all situations, obviously not talking about the immaterial ones because that should never be included, or if it should only be considered when it is significant for the company. So maybe if the board could consider the long list of examples of disclosures and see what is more important in all situations versus what is only important when it is really significant for the company. Looking at the two examples, I think especially the one on fair value measurement has still a very long list of disclosures. And I could be a bit concerned that some of these things would be applied to the largest number in one of the tables, although the number specified in that table might not in itself be significant, because there will always be a number that is the largest, but it might be small. So what is it that triggers the wish? And to Kim's comment, we can always find someone that needs more. What is it that triggers this need? So to avoid it being the largest number in every table that have to be commented on, I think it would be helpful if you could get a bit more guidance on that to move us in the right direction and take it even further. And maybe this is a matter of being a bit more bold than what we are today and trying to get even more out of the historic long list of tables that have to be disclosed.
Thank you, Tina. You managed to find some extra input on top of the other panelists, so a few more questions. Just for the audience in Copenhagen here in a moment, we're going to launch the next poll while we continue this debate. But I'll hand the floor back now to IASB and see what is your reaction or comments to the reactions here from the panel.
Thank you. So some very, very interesting feedback there. I will comment first. I don't know if Bruce will have anything to add. But a couple of things to say. The first is a piece of reassurance that what the board has not tried to do is to require a company to meet every individual need of every person that has ever read a set of financial statements. So our conceptual framework does require us to focus on the common information needs of the primary users, and the board did an awful lot of work to establish what those common information needs were and indeed which were the critical ones. So it's not that the board is aiming for every nice to have item in the world to be disclosed. I agree with the panelists that would be very unhelpful, and that is very much on the board's radar. I think the most prevalent comment for me that came through there were feelings about the long lists of items of information. I got the sense the panelists felt there was still an awful lot in the proposals in terms of items of information being named, and I would agree that that is factually accurate. But just to bring that out a bit, we have a number of different perspectives on this. One extreme view that I have heard during the outreach period is, well, if the IASB is happy that the objectives are the right objectives, could you just eliminate the items of information completely? Just list, the 6 objectives for defined benefits pension schemes and leave companies to comply with them without naming items. And that, to me, is a very valid question, but you've then got the other extreme of opinion, which I kind of touched on in the presentation, which is companies who take the view that, well, if the problem today is a challenge in applying judgment, then the IASB can't just expect us to apply that judgment to comply with these objectives without giving lots of help and guidance to enable us to do that. So that is why those items are there. It's just that they are explicitly not mandatory, to make clear that you're not expected to go through them all and treat them like a checklist. You're expected to start with the objective and use those items to help. All of that said, it is very, very pleasing to me, the comments about moving in the right direction, and actually in the very reason why we've got such a long comment period on this is precisely because the IASB absolutely believes that stakeholders, as you guys have already demonstrated on the panel, will have some really good suggestions. You'll look at the 2 examples for the test standards and tell us, well, okay, yeah, the cash objective might be helpful. I think Kim touched on, but some of the others I still don't completely understand the point, and therefore that needs to be explained better and give us feedback on that. If there are areas there where you feel the items of information are not the right items for any reason, then that again is really super useful feedback for the board about how it can get these proposals to a point where they do genuinely deliver what is needed to improve disclosure. So yeah, I will stop there, but mainly just to say thank you for the feedback. It's very useful to hear your comments.
Any reactions on the EFRAG side on this?
I think the challenges are very good. I personally also think that it can be quite tricky still to understand how the users will ultimately use the information. So I think that is still a good challenge. I also think that the concerns around the fact that the minimum, these disclosure items might just become a checklist, that is something that we struggle with as well, and we share that concern.
Thank you. I think we have the results on the vote on the first question, which is actually linked to this discussion around the objective. And I can see it's coming up on screen now. It seems like there seems to be 2 camps. One camp saying that it will improve the relevance. That's almost half of the audience. And then the other camp seems to say that no certain prescriptive requirements to disclosures are required in each standard to ensure uniform level of information. So there seems to be sort of the 2 camps, and then we don't have to go to the next polling question, yes, but maybe let's take it anyhow. We can see also that there seems to be a majority saying that the benefits outweigh the proposals. Jan, does that stimulate you to ask a question or follow up to the panel?
Yeah, well, a lot has been said already, so there might be some repetition in it, but I will just confirm also that from the audit side, we think that the IASB has teed up something that we have been concerned about. I think we have said here before from the Danish side that this requires some cooperation among a lot of people, so both the IASB and the auditors and the preparers and the regulators. And certainly you have teed up this well, I think, by digging, as I understand, even deeper into the request for information from the investors. What is the actual needs, so that you are trying to match the requirement with the needs? That said, of course, there will always be a lot of investors with different needs. But I think from that side, I think that both the preparers and we as auditors, but because we also struggle with the checklist problem, and we also struggle with the problem that if we are reviewing IFRS financial statements, we do discover quite a lot of boilerplate information that we suggest is more tailored to the individual company. And it is a bit difficult if it's not more clearly expressed in objectives. And we hope this will work. So maybe I have one plea, is that everyone has an open mind to this, and also the regulators, because I accept fully, of course, that the regulator has a certain function that they need to regulate and make sure that the information is right. But I think we are in a trial phase where we need to work with this and see, does it work or does it not work? And even though the regulator then might say we are not satisfied with this, maybe not be too harsh if it's not critical information, but say also maybe try to give a little more guidance to saying it needs to be put in this or that direction, because otherwise you might end up discouraging preparers, because they say, well, okay, now we tried, we work with this, and what do we get? We get criticism from the regulators. And this is not to put the regulators at the spot by any means, but it's just saying, I think it is very important that we have cooperation among all parties to this.
So cooperation, Thomas, turning to you, there seems to be an agreement between the audience that the cost will outweigh or the benefits will outweigh the cost, so it's going to be beneficial. Is that your picture as well, and how do you see this potentially impacting your annual reporting process?
I'm not fully convinced that the benefits will outweigh the costs, because every time we have to change something in our annual report, we have to make sure that our base data is in place, that it's collected, and for a group like ours with more than 900 entities, every time we change something, it's quite a big task. Of course, just removing something is easy, but as soon as we have to change something, or if we have to come up with new information, that's quite a big process. And I see if this is the way forward, I would expect IASB to go through every standard in a similar way. And that would mean that we more or less every year would have to go back to start for individual areas of our annual report, and that would be quite a cumbersome task. So I'm not saying it's wrong to move in this direction. I'm just saying you should not ignore the costs. And I could also see for listed companies with fewer people hired than we have, it will be quite a task to go through all of this in order to meet these disclosure requirements or disclosure objectives. And another thing I noted was the, again, back to the materiality. I noted that IASB proposed to include investors analysis every time they develop new disclosure objectives. I think it's a good idea, but I would really appreciate some balance, because there seems to be some sort of information bulimia at the analyst side, where they at least say they can cope with as many disclosures as possible, because then they will just sift through and find the relevant ones. So I would really appreciate to have both auditors and preparers included in order to balance this out.
And if I can build on that, I think what we see as preparers is that we when we need to explain what happened in the year, what is the relevant information, or at least what we think as prepare is the relevant information for analysts when they go through and assess their financials. We add a lot of information that are not necessarily anywhere stated in the IFRS or any of the other standards, Danish legislation or anywhere else. And when we do that, we do it to be helpful. If you, from the ISB side, go through and look at all of the information that are disclosed by companies today, but are not guided anywhere in any of the standards, I'm pretty sure you will find a lot which has come in because we think it's useful. That's where we actually get a lot of the questions. And when I look at it from the company I have been with for 15 years, a lot of the questions we got is actually related to things that are not in the required disclosure notes. So maybe to build on Thomas's comment, what would be really good is looking at what is the current standard in how the annual reports are prepared. What do companies already provide, and how can we bridge that, and what are the thinking by preparers? Because they might actually already today try to meet the requirements by users. And I don't think that is always, at least not when we are in these processes, clear to us that is taken into consideration. And I think we could gain a lot of knowledge by trying to look at what is done already. How can we use that in a constructive way to meet the requests and the need for additional information that has been raised by users?
Kathryn?
Thank you very much. And thanks again for your comments. Tina, in what you just said, you allowed me to bring in something that I think is really important to the IASB's proposals that I didn't mention earlier, kind of because of time. But what you said about companies already doing everything they can to give investors the information they need is something that the IASB has heard about and has tried to factor into its process. So by way of example, one of the detailed process points in the guidance that the IASB applied with both of the test standards was to look at what we call common reporting practice and learn about instances where companies are choosing to disclose information that is not currently required, and then having done that, think about, well, why are they doing that? And in almost every case, it's because that information is genuinely useful. And so that was another input beyond those discussions with investors about that fed into the development of the right objectives and items of information that would genuinely give companies useful ideas about how to meet those objectives. So what you said there actually went a step further than the existing proposals and is exactly the kinds of useful input that we're looking for that will help the board to make this even better still in terms of process. The other thing I wanted to touch on that you mentioned a couple of times is the idea of what companies record internally and the fact that what management are interested in running the business, frankly, is in 99 cases out of 100 going to be the information that users want. Investors rarely want companies to be preparing information only for disclosure, because the information that is material is typically going to be the information that also enables useful internal decision making. Now, what I don't think we could do, of course, I'm not a board member, so please take anything I say as personal view, but what I don't believe, based on everything I've heard over the years, that we could do is explicitly say in a standard that a company should disclose the stuff that it monitors internally, because then you introduce this concept of, okay, a company could decide not to include something in its management pack, and then it doesn't have to include it in the financial statements. That, for a variety of reasons, that would be impracticable. But what the detailed disclosure objectives do, I hope, and if they don't, please tell us this in your feedback, is make clear that it is the stuff that is useful in managing the business that is relevant to investors. So using that pension cash expectations as an example, it is management's thinking about about how ultimately they are going to deal with a big obligation that they have that forms the information that would meet investor needs there. And we would hope that comes through the required objectives and the guidance that follows. So again, yes, I will stop there, but thank you for the very useful feedback in your comments.
Thank you. I know Kim has a reaction to this.
Yeah, I don't know whether it's a reaction to this, but it's a reaction to what has been said earlier about you've had two approaches from the ones you have talked about, just to develop the objectives or to have a checklist. That's the 2 pointers you can have. I think a lot of people are looking for somewhere in the middle. We're not looking for, the fully objective side here, just to say, okay, this is the overall objective, go out and find out what you want to disclose yourself. Maybe you have the largest company being able to do that, but then we will have the problem that I know EFRAG raised, and I'm also, it's my concern, what about the small and medium-sized entities who might not have 15 people working around doing a financial statement? How should they develop their disclosure requirement? So I think, instead of saying, no, we just want the objectives or we want the checklist, I think we should try to say we want the objectives, but we might also want some of the checklist, but we want it shorter than it is today. Saying that the disclosures that you have today might be too many. And my concern is kind of a little bit the same as EFRAG has raised, that even though they are not mandatory, if you do not disclose them on something that is material, then you have to argue towards the auditor and towards the regulator, why didn't you disclose that information, even though it was not mandatory, but the amount that you have, the instrument that you have in the financial statement is material. And then you need to have, a really, really comprehensive materiality memo without saying, no, we did not disclose this because we think we have given the information due to that and that and that information in the financial statement. I think that will also lead to a lot of work in arguing between the preparer, the auditor, and latest the regulator in that situation. So I think we need to find a middle way here, not either way or the other, but we need to meet somewhere.
Sorry to jump in, but that is such a relevant comment. And if I may very briefly throw a question at you, because I think this gets to the absolute heart of the project. So what you've said in terms of a minimum checklist, if I may call it that, is something we have heard from a number of stakeholders. And I would love to hear your opinion on the fact that today we have, I think, as you guys have said yourself, quite a long list, that people perceive as quite a long checklist, and still we have the problem that there is relevant information missing because companies take the safest approach of applying that checklist and just aren't left with the time or the space to go that step further and apply materiality. So what I'd really be interested in the panel's view on is whether, if you think the board tried to find a middle ground with some minimum requirements and some areas where you'd leave it up to judgment, do you think it would realistically address the problem today, or do you think it would be the case that the treatment of the minimum list as the compliance safe house would remain, and therefore the lacking relevant information would not be achieved where there's entity specific things going on? I hope that makes sense. We're very interested in your views.
And I think you definitely got the attention of the panel. I can see both Kim and Thomas want to come in. Thomas?
Yeah, I think it will help, but I think it will not solve it. And the reason why I think it would not solve it is that basically an investor or analyst have two information needs. One of them is future cash flows. The other one is risk. Now, both of these are related to the future. So when they say that they are missing information in the financial report, that's often because what they're really searching for is information about the future, which we, of course, are very reluctant to disclose. I mean, we have been able to see how difficult it is to look just a few months into the future for the last year and a half. And furthermore, it will be subject to an audit, and the auditors always have to put in an extra effort and still having problems with auditing statements about the future. There is an inherent uncertainty in this, And that is really what we are trying to address here. So we will not completely close this gap of including all the missing information, but we will get a teeny step closer.
Yeah, I think Thomas fully right in that, but I will also address what Tina said earlier. If we were looking into the disclosure checklist today, not just to say it's where, but it's what we have today, you could point out what is material. This is really material information. We want that information, and then you could have other information that is not that material, where you could have more room to do something else with that information. My concern is still also the small and mid-sized entities, because they need inspiration to what to include in the financial statement. You cannot just start on a blank paper and say, okay, please design the disclosures in the financial statement. So I think we need to work towards the middle. And I agree with Thomas, we will never solve the problem, because there will always be asking for more information in this regard. But I think we can go a long way, and maybe to get a little bit rid of the disclosure check mentality that we have today. Because the reason why we are where we are is that's the safest way. There's a lot of disclosures, and if you just check it all, then you should be home safe.
And if I can add just one example to this. Today there's a requirement on a movement table on gross liability, gross assets, and then the net liability in pensions. How many companies would dare to take that out with the new standard? I am not sure anyone would dare that, but it doesn't tell anything about a cash flow, and it tells nothing about the risk. So with the information required by users, this is useless, putting it very, very boldly. So for a lot of companies where this might not be an immaterial number, I think we need a push for everyone to take it out unless it's really significant. And that could be just one of the examples. And I think a bit more help on that would move and change the disclosure notes more than what you have now.
Thank you. We will launch the next polling question shortly. But Kathryn, do you have a reaction to that? And then I have two questions from the audience, but I don't know whether you want to react on especially the last comment from Tina.
Probably the best reaction I can give to that is to re-highlight the field work that Fredré mentioned earlier, because I think your comments, Tina, about whether companies would feel confident that they can really take these judgments when they apply these proposals is absolutely key to their success. So what we are doing both in Europe and globally at the moment is working with a lot of companies who are taking the proposals for either or both of the two test cases and literally applying with us and sharing the results of that. So it is too early to say conclusively what the outcomes of that would be, but the process is highlighting, for example, the consequences of auditor relationships and companies that feel they couldn't take things away that they feel are immaterial for that reason. It's highlighting those instances where companies do feel they can make changes. So we've had some companies who say, oh, you know, this has given us really good ideas, and actually we could implement some of those this year, never mind waiting for the outcome of this. We think this is a genuine improvement. So we've had lots of different conversations that we're still exploring, but part of that is absolutely the risks around would this actually deliver the confidence for companies to remove the things that they don't think are adding value when it comes to investor needs. So it's not a conclusive answer yet, because it's so important that it's something that we are doing a lot of work on during the comment period, but I think your input is very relevant and valuable, so thank you.
Thank you. Just turning to two of the questions from the audience. There's one on XBRL tagging. And I mean, the XBRL tagging is essentially there to support faster analysis of disclosures. But how does the XBRL tagging fit into the disclosure project? And I mean, Thomas, you talked a little bit about data and the need to, I suppose, have stability in your data generation. Because you cannot simply from year to year change what data you generate. But I suppose this goes a little bit more into as well the tagging of the actual annual report when you produce the annual report. Do you see any issues in terms of that tagging exercise when you actually produce the report at the end of the day, or will this rather be an issue for the users of the XBL data if the disclosures is changing? Or
I don't know. I mean, it all comes back to we would like to see a mock-up like EFRAG are working on in order to see where we end. But my guess is that a lot of it will end up as club tagging. So that will not be a really big issue here. But I don't know. But basically, I think all of these ways of working with things electronically, I think it's already been overtaken by AI that can sift through a PDF and get all the relevant information. So this tagging thing will disappear again, and it will be less relevant, at least in the future.
So I mean, my take on it is that is not for you the game changer in this. And as far as I understand as well, in a number of instances, essentially the XBL tagging comes at the last stage, more or less, in the reporting process. So from the preparer side, it wouldn't necessarily be an issue. Probably then when you look on the users of the XBL, because you have to have a taxonomy that has to cater for a variety of reporting. So I suppose the answer to the questions somewhere lies there. And I'll allow you a little bit to reflect on it, both you, Kathryn, and whether you, Fredré, as well, have an opinion on this. But before handing the floor to you, Kim, there's another question that I think I'm going to pose to you, because that is essentially talking about the issue about the checklist approach and the pressure that you either have or perceive to have from ESMA and national enforcers. And I quite often hear the fact that auditors feel they are pressured from the regulators, and in order to meet the regulators' demands or concerns, they then produce the checklist themselves in order to ensure that they are not going to be in violation with that. And that sort of seems to be one of the drivers of checklist. Probably not the only one. But how do you see that? And
I think, as the question asked, I think it's as important to get the regulator view on the new proposal from IASB, because we need the regulator to be part in this. If the regulator just waits until the proposal has been submitted and we have a new standard or new standards, then the regulator comes up and has the attitude that we have seen earlier on, then we face a situation where we might end up in a checklist situation again. And then all of the hard work might be lost on the floor. So I don't know whether it's because of regulators that we do the checklist. We do the checklist for ourselves, for our own perspective, to being able to secure that we are in compliance when we are auditing the financial statements. So it's not because the regulator goes out and says to the auditor, we want the checklist. If they go anywhere, then they go to the company and say, we would like to see the checklist that you have actually done in that situation. But I would be keen to hear if IASB or EFRAG has talked to ESMA in this process, to hear what are ESMA's thoughts on this project.
So I'm going to jump in. Thank you for that, Kim. Yes, ESMA is, of course, one of our official observers, so they have been following all our work on this so far at both TEG and board meetings. We have also been having individual or offline conversations with them about how to involve them, because we think it's very important for them, or for us, to understand how they think about enforceability, just like we ask the same question of the auditors. So what I can say now, this is still early days, so I don't want to say too much. We're still busy figuring it all out. But ESMA has indicated that they will partake in the field test, in the sense that depending on the permission we get from the participants, so that's the first point, whether they agree to this, the national enforcers will look at the mock disclosures and then see how things have changed and what conclusions they can draw from the exercise and how they think that would impact them from an enforcement perspective. I do think that it might make things a bit more difficult in the sense that, well, maybe more difficult, but it just means that preparers and auditors will have to be more reasoned, I think, in their thinking about why they exclude or include various things. So in short, ESMA is very involved. We will continue to work with them and get their feedback on the details. But like I say, this is subject to agreement with the participants. So we will have to see exactly how far that extends. Kathryn, I don't know if there are other regulators that you have had some interactions with, which might also be relevant.
Yeah, thanks, Fredré. So absolutely echo your comments about the importance of regulator input and the fact that we are hoping that they will be able to be involved in the fieldwork exercise. The other thing I would add on regulators, and yes, we have spoken to a good number globally, is that I would say they, as much as any other stakeholder group, really agree that there is a problem that exists today. And I have heard many regulators say that today they want to focus their reviews on what is material. They want to be doing that instead of focusing on a checklist. So, for example, they might look at the information accompanying the financial statements, see there's something really interesting and material going on, and then say to a company, well, you know, shouldn't the notes to the financial statements be focusing on this, because it seems like something that's very important. And what they have said to us is that today all they have to work with in that circumstance is that very general paragraph in IAS 1 that says, oh, if there's something relevant, you need to disclose it. But that just isn't enough to form the basis of really meaningful discussions between companies and regulators, companies and auditors. And today we're told those conversations stall. So the idea with the proposals when it comes to regulators is that they will be able to point in the standards to precise user needs that need to be satisfied and have really meaningful conversations about, well, is this actually satisfied? And if not, what needs to change, rather than ticking down this checklist, which we've heard from regulators they themselves don't want to do. I must caveat all of that and say they have not given formal opinions on the proposals yet. Like everyone else, you know, they really need to interrogate them. The direction of travel has a lot of sense in it, but like the people on the panel have raised, regulators, as much as anyone, really want to flesh out potential concerns about, you know, whether this is operational, the level of judgment applied, etc. So I absolutely would not comment on their views on the proposals. It's too early and we have to wait for the comment letters and let regulators give us their view themselves. But the one thing I would add to what Fredré says is, you know, they do really acknowledge the problem as much as anyone else and are keen to be part of a solution, you know, whatever the best solution turns out to be when we've all worked together. I know the other question on digital reporting, you mentioned it would be interesting to hear our views on. Just to say that the board did really think about this in developing the proposals, and specifically it thought about how the proposals would work with the IFRS taxonomy to serve as a real example of could tagging work. And to cut a very long story short, the board's expectation would be that every single item that appears in proposals framed in this way would be the subject of a standard electronic tag. So every objective, every item of information that appears, such that a company could consistently tag everything related to a particular user need, and that could be extracted for all companies, and that companies that had chosen to use the information named in the standard could again consistently tag it, and that information could be consistently extracted. The concern, of course, is when companies disclose entity-specific information not named in the standard, they have to develop entity-specific extensions which cannot be extracted consistently for different companies. To be honest with you, though, if the outcome of these proposals is companies disclosing entity-specific relevant information, frankly, I would see that as a good thing. When they do that today, electronic reporting extensions are needed. That wouldn't change. challenge. And the final thing I would add is to reiterate those important process points. We've talked about common practice reviews. We've talked about working with investors. The items that are typically going to be relevant and material to many companies, if the board's done a good enough job, they should be somewhere in the proposals and therefore the subject of an electronic reporting tag. So I've covered that very briefly, but overall, the board's conclusion is that that should work. But again, super interested to hear feedback as we move through the comment letter period.
Thank you very much. I think we have the results as well from the two pollings. And one of them was question 4, and clearly the proposal aims to improving the relevance of disclosures. But some was concerned about comparability that we are also discussing right now with the tagging. And the majority, around 65% or something in that neighborhood, says that there is a risk that they will disclose different things. I think that was just that you highlighted currently in your response and saying it will be more entity specific. But also interesting saying that a third that is saying that comparability would be achieved in all material aspects. So I don't suppose this is really surprising to you, but I think it confirms the discussions we've had so far. And then just turning to the polling result of the next question, in terms of the need to exercise material judgments, it's more also fairly biased towards the 65% saying that the current approach leads to a checklist attitude, which we have discussed. But also quite a fair number of people is saying that the exercise of judgment is already required. So not necessarily a full clear steer on this side, but I would say an overweight in both two questions. I know, Tina, that you have also a comment in relation to the disclosures, but also maybe the ability to reflect strategic changes, for instance.
Yeah, thank you, Kristian. And it's both in relation to strategic changes, but it also links to the debate we have had on comparable figures. And now I'm within the company and not company to company. What I think would be really good if we could achieve with the new standard is more flexibility in how we can develop the disclosures. When you have strategic changes, it could be a full new strategy, it could be restructurings, it could be acquisition of entities, or it could actually also be an exposure that are only relevant in 1 year. For instance, a fair value exposure due to new contracts, etc. So all of those kind of situations where we could do specific information for that year, where we won't have to provide any comparable numbers for the year before, because it's something we haven't collected as a company. So back to Thomas's comment on the huge amount of work in larger companies when you have to get comparable information or have to tailor new information and get that all the way through the bookkeeping systems or whatever way we have to gather it. So if we can move to a set of objectives where we can do something that is only specific for that year, so no comparables to the year before, and it will also go out in the following year, given, of course, it's not relevant anymore, but it has to be assessed every year. And we are sort of lacking that right now, and I could be afraid that some companies are then a bit reluctant on how much they provide. Because you are today required to get the past and as well as follow up on it in the future. So a bit more flexibility on that. And I think that would improve disclosure significantly by providing that. So if the standard could provide some wording around how to work with those situations, and of course not make the annual reports uncomparable year on year, that's not the aim of it, but it's actually to improve disclosures in those situations.
Thank you. Is that something that you have reflected on, Kathryn, or?
Yeah. I mean, I think that's extremely valuable input, and it touches on the importance of companies disclosing the strategic information that is most relevant in any given year. And I mean, speaking personally, I would completely agree with that, and it's certainly something we can factor in as we think about sort of almost whether this approach achieves what you've described.
Thank you. We are close to the end of the session, and of course you're always welcome to post questions in the chat. I have one last question, and that's to you, Thomas, because we haven't really touched a lot on the IFRS 13, but what is your opinion on the disclosures, especially in terms of the alternative fair value measurements that were in that? Your reaction to that?
I think I will put it a bit more blunt than EFRAG, that it's stupid. Basically, what we are talking about here is level 3 measurements under IFRS 13 are really difficult. There is quite a wide potential outcome, and removing sensitivity analysis in order to come up with some other number that's still within this potential range. Well, first of all, it makes it much more difficult to us because it's already difficult to make level 3 disclosures or level 3 measurements, and that would mean that coming up with an alternative to that, there's so much we could pick and choose from, but basically we consider it irrelevant. The one we are putting into the accounts is the one that we are considering the most likely, and sensitivity analysis is much better at illustrating this uncertainty that's built into this. So this is something I would really like to see be removed from the proposal.
So Kathryn, before handing the floor to you, maybe Fredré, do you have anything to add to this? I know Thomas said he put it a little bit more bluntly than you did, but...
Yes, I think I was just trying to say that it concerns me, the focus that the discussion has been getting. I would say that when I was in practice at a bank, some of the people I was working with were quite concerned that the sensitivity analysis, because it focuses generally on one unobservable input, it doesn't take necessarily into account when things go in the same direction or opposite directions or whatever. So you do have some people who don't believe the sensitivity analysis that we do currently is particularly useful either. So I do want to throw that out there as well. And I do think the whole idea is to leave it to users to decide in this range. You obviously have decided where you want to be, 95 to 110. You've chosen 100. That's fine. But the question is just, should people know of the 95 to the 110 and maybe decide, well, we would have done 105. It's not that it's wrong. It's just a difference in judgment. But yes, I think that is very interesting view of what we're trying to achieve here and what would be useful.
Yeah, I mean, if I could just jump in, firstly, thank you for the very clear feedback. We like bluntness. It's really helpful when we know what people think. This objective, and there is a similar one in the pension proposals as well, has caused a lot of debate. And I'm not going to get into detailed drafting issues, but it's important when we hear feedback to understand almost what is the underlying issue. Was the board's intention the right intention? And frankly, did we on the staff, did we draft it well enough that the board's intention was clear? And without wishing to put myself down, what I will say is that I think on this objective there has been a degree to which the words we used could have been clearer, because it's come through field work, it's come through some of the comments made in outreach, that there is this perception that what the board is looking for is for companies, so say you've got a property, to think about, well, different valuation methods you could have used and what would the alternative outcomes have been. It's not really about that, and the words in the objective objective itself, as opposed to the heading above it, make clear it's about, well, almost what could the effect of alternative reasonably possible inputs be. So we have heard from users that these detailed assumption by assumption sensitivity analyses, they often don't reflect realistic scenarios, and therefore they're not the simplest way to say to a user, okay, the potential exposure here is this big. You know, this is the number we've landed on, but this is how potentially different it could be. Users think there's a simpler way to do it, and some companies agree that that's how they think about it anyway. So in keeping with the theory of the board's approach, what this objective is intended to do is explain that underlying user need, i.e. how reasonably possibly different could this be, and give companies a bit of freedom to respond to that in a simple and potentially less onerous way than they are explicitly required to do today. That said, we've heard a lot of feedback on this, which we are listening to. So as the board, you know, goes back to the proposals after the comment letter period, I'm very sure that your and every comment on this topic will be discussed very thoroughly by them.
Thank you very much. Just looking to the panel, just seeing whether there are any more questions. I can see people shaking their head. And I mean, Kathryn, as you probably understand, we are from Scandinavia. Sometimes we're a little bit blunt in the input. But it also comes with a smile that I hope you recognize that and as you probably understood from the discussion so far, we really appreciate the overall approach. There will always be a few areas here and there where we may say that we haven't quite hit the head of the nail, but that being said, I mean, it did come with a smile, and I hope you appreciated that, and I can see you smiling as well, so I think you've taken it on board on that. Do you have any closing remarks on this topic, Kathryn?
Just to say thank you for the very useful input, and I might just ask Bruce if there's anything he'd add in closing.
No, just to say thank you to everybody. I mean, this is one of those projects I'm really excited about, and because I think it could change the way in which companies do prepare their disclosures and hopefully make them more useful. I do take on board a lot of the comments that were said. I mean, I think that's why we brought this out as a pilot approach, because you know, we need to start somewhere, and I think we've had a lot of valuable input from the panel. And the questions that came in that give us some thoughts to think about. And I just encourage anybody out there who hasn't thought about sending in comment letters, please do. We really need to hear what people think about it and get that feedback so that we can feed that into our process. But yeah, thank you very much for everybody in the panel on that.
Thank you. And any reaction or closing remarks, Fredré, on your side before we move to the next topic?
Those of you who have availability, please join the field test or have an interview with us on this, please, please, please. But otherwise, just like Kathryn and Bruce said, please just join us with comment letters. That also is a big help. Some of the disclosure questions that you get in these two topic areas would also be really useful, and whether you get specific questions at specific times, like during COVID, during the last crisis, whatever, those would also be really useful information. But thank you so much, really informative.
Thank you, Fredré, and you answered my unspoken question whether there was still time to join the field test. So let me also convey that message that it's extremely helpful if you join the field test in order to improve this. We will now have a small change in terms of people in the crossfire from IASB and EFRAG. I will hand over the floor to you, Bruce, I suppose, and then I suppose you will coordinate with Michelle on the next project. So, Bruce, the floor is yours.
Thank you very much. I'm just going to ask the team just to put the slides up. Brilliant. Thank you. And thanks for the opportunity to present this project to you guys, the subsidiaries without public accountability. From a personal point of view, I strongly believe in this project. In my past life, before joining the board, I felt the pain of having to prepare dozens of subsidiary accounts, which obviously had a very limited value, but still had to comply with full IFRS. I think the hope that we've got is that this project will give relief to such entities. If we just move to the next slide. So as I said, the purpose of the session is just to give you a high-level understanding of what we proposed in the exposure draft. The good news is we're not going to go through every single disclosure item that's in there. I would ask that you could take a look at those outside of that, but just talk to you a bit about why we've undertaken the project, how we've actually decided what disclosures, etc., go in, and a bit about the structure of the standard. We can go to the next slide. We just move on to the next one, thanks. So why do we undertake this project? Now, many subsidiaries, as you know, are not publicly accountable. However, subsidiaries applying full IFRS standards in its financial statements still need to give the same disclosures as those in full IFRS. And remember, the full IFRS disclosures were designed for entities with public accountability. Now, whereas they could apply a local GAAP or potentially IFRS for SMEs in jurisdictions where that's available, this is not always available to entities and doesn't offer a cost-effective alternative. So, for example, a subsidiary may have to maintain two sets of books, one being for the IFRS consolidated accounts and then a separate set for the individual accounts. Now, we identified when we did the 2015 agenda consultation that entities wanted us to take a look at potentially introducing relief for such entities. So what exactly are we proposing? Well, think about a simple scenario where we've got a listed company with 50 subsidiaries. All the focus at year-end goes into preparing those consolidated glossy financial statements. And once those are done, then all the joy of now having to address those 50 individual subsidiary accounts starts. Where these are required to be prepared under IFRS, this is a very onerous task. Now, the objective of this project is to introduce a new standard addressing this type of reporting for these type of entities and hopefully give some relief to them. Now, let's take a look at some of the benefits we hope to achieve in doing this project. If we move to the next slide. If we can go to the next one, thanks. Now, I think if we take a look at the key benefits, to start with, where a subsidiary elects to use the standard, remember that they will still apply all the recognition and measurement principles in the full IFRS standards. But we believe there will be cost savings when it comes to the disclosure requirements in these individual accounts. Now, this standard could conceivably eliminate the need for subsidiaries to maintain two sets of books. In other words, they may not need to have a local GAAP or an IFRS for SMEs, but could just use this for their primary accounting in their individual accounts. Now, we are, however, mindful of the fact that the usefulness of the financial statements still needs to be maintained. But given that these are tailored to the needs of users of subsidiary accounts and that these disclosures will be tailored to non-publicly accountable entities, we believe the advantages will result in maintaining usefulness. Now, in trying to achieve this, let's look at the scope of who can apply it. I think the key thing when we start looking at the scope is it's important to remember that this standard is voluntary. So if a subsidiary decides that they still want to use the full IFRS disclosures and the full standards, they can do so. Now, this standard applies to both the consolidated or individual accounts of any subsidiary. That, firstly, does not have public accountability, and secondly, whose parents prepare consolidated financial statements applying full IFRS. Now, just reminding you, public accountability includes entities that either have publicly traded debt or equity, or entities who hold assets in a fiduciary capacity for a broad group of outsiders. So if you take a look at this, our anticipation is that most banks and insurance companies will be scoped out of using this. I think it is important to note that, as I said up front, that you can apply this to both the consolidated or individual accounts of the subsidiary. But remember, we're not talking about the ultimate parent's consolidated accounts. We're talking about that subsidiary's consolidated accounts. Now, maybe one of the ways to just explain some of the values to just take a look at some of the examples that we've got here. So if we take a look at these three scenarios. In the first scenario, we've got a parent who's preparing consolidated accounts using full IFRS. Where they've got a subsidiary, and that subsidiary, as I mentioned, doesn't have that public accountability, they would be eligible to use the standard in their individual accounts. In scenario 2, where the parent's preparing consolidated financial statements applying local GAAP or some other GAAP, then they would, because the ultimate parent's not using full IFRS, the subsidiary would not be able to use this, and if they're required to, would have to use full IFRS. In our third scenario, we've got the ultimate parent who doesn't prepare consolidated financial statements, but there is an intermediate parent who is preparing consolidated financial statements using full IFRS. In this situation, the subsidiary does not have, providing the subsidiary does not have public accountability, we would allow them to use the standard in their individual accounts. Now, obviously, who can use it and where that goes is going to be a matter of how each country decides to take on their legal parameters, who decides what they're going to allow them to do. But I think that everybody that we've spoken to so far has clearly indicated that this is the right direction of travel. And of course, we think this could meet the objectives that we detailed above. Now, how do we develop the approach and decide what disclosures go into the standard? Well, to take us through it, I'm going to hand the rest of the next part of the presentation over to Michelle, who'll talk a bit about the approach. Michelle, over to you.
Sorry about that. Thank you very much, Bruce. Yes, as Bruce said, I'm going to talk about how we developed the disclosure requirements. So if I could have slide 28, please. Well, the approach was to start with the IFRS for SMEs disclosure requirements and then to adapt them where we needed to. Now, I want to explain why we started with the IFRS for SMEs disclosure requirements. And that was, in a way, the board had already done its thinking on the disclosure requirements in the IFRS for SME standard. So in this project, we really borrowed the thinking that had gone into developing the disclosure requirements in the IFRS for SME standard. That is, the board had already taken the disclosure requirements of IFRS standards, looked at the needs of SMEs users, and reduced those disclosure requirements. So by starting with the disclosure requirements that were in the IFRS for SME standard, we had a head start, and it also meant the board wasn't developing new disclosure requirements. So one of the things that's important in this project is there are no new disclosure requirements that couldn't be found either in IFRS standards or in the IFRS for SME standard. So if we could move forward, I'll look at how we develop those disclosure requirements. Now, many of you may know the IFRS for SME standard is a simple IFRS standard, and it sometimes has simplifications to the recognition and measurement requirements from those requirements that are in IFRS standards. And because disclosures obviously support what's in the financial statements, we needed to look into those recognition and measurement requirements and see if there were any differences. Now, in the instance where there were no differences, we could easily use the disclosure requirements in the IFRS for SME standard because we knew the board had already adapted those and it had already applied its thinking to those disclosure requirements. In those instances, all we did was to make the language consistent with IFRS standards and to update some of the cross-references. In the instance that there were differences in the recognition and measurement requirements between the IFRS for SME standard and full IFRS standards, then we had to do a bit more thinking. Now, as I said, the IFRS for SME standard sometimes includes simplifications, but the IFRS for SME standard is also only updated periodically. So we also had to take into consideration that full IFRS standards had some new requirements or revised requirements. So in that instance, what we did was we again used the thinking that the board had used when it developed the IFRS for SME standard. Because in developing the IFRS for SME standard, the board came up with some principles that it used to simplify the disclosure requirements. And those principles were based on some research that the board had done with users of SME's financial statements, identifying their key information needs. So what we did, where we had a recognition and measurement requirement, we looked that was different between the IFRS and the IFRS for SME standard. We went to IFRS standards, we applied the principles for simplification, and we've proposed those requirements in the exposure draft. Okay, so that provides a quick overview of how we've developed the disclosure requirements and how we've used the thinking from the SME standard, but how all of the requirements that are in the exposure draft come from IFRS standards. So moving forward in terms of which standards, so we needed a sort of cut-off point. Now there was a long conversation with the board about IFRS 17. IFRS 17, as you probably know, is a new accounting standard for insurance contracts. It introduces a new model for insurance contracts. And we were faced with, could we reduce the disclosure requirements? When we looked at reducing the disclosure requirements, we found ourselves that there wasn't a lot that we could reduce. And we also thought, well, this is a new model and the disclosure requirements support that new model. So maybe it would be better to wait and think about the disclosure requirements before we went for a reduced disclosure requirement. But there was another consideration as well. And as Bruce has explained the proposed scope of this exposure draft, we weren't sure that there were many entities that were issuing insurance companies that would not have public accountability. So it's really that second part of the definition of public accountability, where entities are holding assets in a fiduciary capacity. So in the exposure draft, we've actually asked a question about this, and we're looking for feedback on insurance entities and whether we think they would be, or you think they would be, in the scope of the standard, so that we can consider this. And then IFRS 8 and IAS 33, these two standards, they both have scopes that are for publicly accountable entities. They're not in the IFRS for SME standard. And we discussed with the board whether we should propose reduced disclosure requirements, but we felt they wouldn't apply to most subsidiaries. So as a consequence, the board has said if a subsidiary opts to make those disclosure requirements, then what it can do is provide the disclosures that are required in those standards. And at the time we were drafting the disclosure requirements for this exposure draft, the exposure draft on general presentation and disclosures comment period was ending, and we felt it was better just to leave that one and come back to it at a later date. So moving on, I just wanted to make clear one of the questions that we've had is about where does this standard fit? And as I said, we only borrowed the thinking that the board had previously applied in developing the IFRS for SME standard. The exposure draft would be an IFRS standard, and it would be therefore subject to the normal European endorsement processes. Okay, let's have a look at the structure and how you would apply the draft standard. Thank you. So the main body of the standard is just a disclosure standard. So what we do is we set out the objective and the scope, and then we provide some information on how an entity can elect to apply this standard. I think it's important to note that an entity can elect to apply this standard, so it's an optional standard, but you can also revoke that election. And we also felt it was important that an entity could reapply the standard. So we set out how you can reapply the standard in that section. We've also set out the interaction with IFRS 1 because actually applying the standard for the first time doesn't necessarily mean that you're a first-time adopter. So the first-time adoption applies. We've set out reduced disclosure requirements if you are a first-time adopter and you are applying IFRS 1 and electing to apply the draft standard at the same time. And then in terms of application, the standard sets out the disclosure requirements. And then in the appendices, we set out the disclosure requirements that are in IFRS standards that are replaced by this standard. So in effect, Appendix A says, here's a list of disclosure requirements in IFRS standards that you no longer have to apply. You only have to look at the ones that are in the exposure draft, in the draft standard. And then in terms of transition, the board is not proposing any transition requirements because if you're already in IFRS standards, you will transition just by having reduced disclosure. So we felt in those instances there was no need for transition provisions. If you're a first-time adopter and you're applying this standard, you'll be applying IFRS 1. Again, there's nothing specific that we needed in this standard. And then there are a few consequential amendments. So that's the draft standard. We do receive a few questions that I just wanted to go through. One of the questions is am I still compliant with IFRS standards if I apply this standard? The answer to that question is yes, you will be compliant. But the exposure draft does propose that you also disclose that you have applied the draft standard. We felt it was very important for users that they understood that a subsidiary had elected to apply this draft standard. Otherwise, you could have two subsidiaries, one electing to apply the standard, one applying full disclosures, and we wanted to make that clearly visible to users. I've discussed the interaction with IFRS 1. It's clear that if for example, if you had been IFRS in full and you've made the compliance statement in a previous year, in this instance, you wouldn't be required to go back through IFRS 1. So we've set out that. Transition I've discussed. And then one of the questions that we do receive a lot of comments on is maintenance. And what the board has decided is that going forward, when it publishes an exposure draft, it will publish consequential amendments to this standard. So if the board published an exposure draft and that exposure draft proposed disclosure changes in IFRS standards, the board would apply the principles that it has already applied to reducing disclosure requirements and propose reduced disclosure requirements for this standard. And then finally, in terms of the timeline for this exposure draft, so we only actually started this project in 2019. So I think the staff have done incredibly well to go through the detailed analysis of all of the standards. We've published the exposure draft this year. Obviously, it's out for consultation until the end of January. And we would hope in the first half of next year to be discussing the feedback with the board. There are materials available, and it's likely we will produce some education materials to support the exposure draft. So do recommend that you log on to our web page and have a look at our web page. And with that, I'll hand back to EFRAG.
So thank you for that, Michelle and Bruce, for that extensive overview. I don't know whether EFRAG is ready to come with their comments on this. Seems to be an issue.
Good morning, everyone. EFRAG welcomes the IASB proposals to provide reduced disclosure requirements for subsidiaries without public accountability. On the scope of the project, we currently cautiously support the proposed scope, which is limited to subsidiaries which do not have public accountability and which have either ultimate or intermediate parent producing consolidated financial statements under IFRS. And those statements should be available for public use. We also highlight that there is an alternative view, François Flores, that all entities without public accountability should be eligible to apply the IASB proposals. It could include, for example, associates, joint ventures, joint operations, and maybe some other entities. It can also be noted that cost savings for the subsidiaries could also be quite limited from application of those proposals because they will have any way to produce the disclosure requirements and for the reporting package of the parent for the full IFRSs. And given that this alternative view in Europe has a lot of support and the interaction with the IFRS for SMEs, which is not endorsed in Europe, and it depends also on each jurisdiction and on each member state how the standard was applied in using the local legislation. EFRAG decided to ask a question to constituents for their views on the scope of the exposure draft. So whether the scope should be broadened to include all entities without public accountability. Currently, the scope as defined in the exposure draft also excludes most banks and insurance companies, as they have a fiduciary capacity. However, there may be some types of insurance companies which will fall under the scope of the ED and will have to apply the extensive IFRS 17 disclosures in full. Therefore, EFRAG also decided to ask a question to constituents to see what entities in the scope of the ED issue insurance contracts and what type of disclosures would be relevant for them. Because maybe, yes, the full IFRS 17 disclosures would be extensive. Next slide, please. EFRAG also highlights that the IASB proposals are likely to put pressure on the definition of available for public use. And why is that? The IASB uses this concept, which is described in IFRS 10 consolidated financial statements. And this concept also defines the scope of the exposure draft. Some European jurisdictions allow the use of IFRS in the annual and consolidated financial statements of non-publicly traded companies. And these financial statements are often available for public use because they can be officially filed, for example, in commercial register or with a regulator or published on the website. However, there could be cases where consolidated financial statements of the parent are not available for public use, and therefore its subsidiaries would not be able to apply the reduced disclosure requirements. We also express concerns that the entity must be a subsidiary without public accountability at the end of the reporting period in order to be included in the scope of the project. In some cases, it could be problematic, for example, where an entity ceases to be a subsidiary near the end of its reporting period and its user needs remain the same. And in this case, EFRAG suggests to consider alternative for such entities, for such situation, for example, give a grace period of last 3 months or something like that. Concerning the approach used to develop the reduced disclosure requirements, we agree with the approach which IASB used, but we suggest to include also the cost-benefit considerations, which will cover also the reduction of cost for preparers, which is one of the main objectives of the project. We also note that IASB already refers to this in the paragraph BC 29 about the user needs and cost benefits. We also highlight there is a risk of not considering the existing disclosure requirements in IFRS standards when there are no recognition and measurement differences between IFRS for SME standard and full IFRSs, but there are timing differences between the update of the two. More specifically, the risk of increasing the number of exceptions and inconsistencies, as only some, but not all of those recent improvements to disclosure requirements in IFRS standards are included in the exposure draft. We also suggest improving the reasoning for the exceptions made to the approach to develop the proposed disclosure requirements, as we consider that in some cases they're not entirely clear and it makes them more complex to understand. Next slide, please. Also, we suggest to consider the interaction between the disclosure requirements of this exposure draft and also the disclosure initiative project, because here in the disclosure initiative, the emphasis is put on defining the disclosure objectives and not on the list of disclosures as in this project. Of course, it could be argued that for subsidiaries, it would be easier to use just this list of disclosures approach, but still the interactions of the two, we think it's important that it's considered more profoundly. Also, we consider that the application of a full set of disclosure requirements for IFRS 17 can be burdensome and costly for the subsidiaries in scope. We also suggest the number of disclosures, as we consider that they're still relevant for the users of financial statements of the smaller entities, and which would not increase significantly the cost for preparers. And this number of disclosures we identify in Appendix A, and we are waiting also for the feedback of the constituents on it. And we also highlight that the assessment of user needs in terms of disclosures remains difficult and subjective. Next slide, please. Concerning the timeline, our comment period of our comment letter ends on 26th of January next year, and we invite to submit your comments via EFRAG website, or you can use also the link which is provided to this presentation. And with this, I thank you for your attention.
Thank you very much for that and for this presentation, both on the IASB side and on the EFRAG side. clearly already now for the two presentations that it is clear that there are some topics to be discussed, some divergent views, even in the proposal. But I'll first hand the floor over to Tina, because, I mean, as a preparer and having governed over a number of subsidiaries and having had the experience, how do you see this proposal?
Thank you, Kristian, and thank you to the board for actually now moving ahead on this. As prepared, we've been waiting for this for years, probably since 2005. This is a huge step forward. Yes, there's still areas that are to be discussed, but as a group, it is extremely time-consuming and cumbersome to deal with full IFRS at group level, as well as in all subsidiaries to comply with the group requirements, as well as all of those have to deal with either IFRS for SMEs, or they can go full Monty with all the disclosures in full IFRS, or as a third option, whatever local GAAP that might be applicable. There's no doubt that if we can move towards what is described, at least for subsidiaries in this proposed standard, that will take out a lot of work across global groups. To EFRAG's comment, I really support that this should also be a possible solution for all joint ventures as well as associates. What I think we should consider in this is that the entities within a group are typically not in themselves of much interest for any users except for local governments. In many groups, funding and all assessment of a group in terms of investments are made at a group level. And obviously, if there is subsidiaries, or it could be joint ventures or associates that have separate, very material funding, they might need to add something. But most of these entities are, as I said, in themselves of non-interest. So to me, this should be a very narrow scope set of disclosures, reflecting the fact that the entities as standalone are dependent on the group. For a lot of them, the business that they have are based on a decision made at group level on what you put into each of the legal entities. So supporting the fact that at times analysts might want to dig into major subsidiaries, then they could find disclosures now that support what you have in the group, because the recognition and measurement are exactly the same. I think this is the right step forward. But given the fact that a lot of associates and joint ventures are just as material, and those are typically not relevant in terms of local materiality, in terms of other funding, as I said, or any other kind of national or local interest, I suggest that you expand the scope also to include those two. When I then look at where we are heading with this, it is definitely a step in the right direction. But just going through the standard, there are still more than 180 items in the standard paragraphs with disclosures that needs to be provided in an entity applying the proposed standard. And I have not included IFRS 1 because that's a one-time set of disclosure. So this is IFRS 2 forward. And if I then exclude the more specific standards that only very few companies will have to apply to, you are still of around 150 set of disclosures. When I compare that to what we have in most national requirements, this is quite extensive. And I would suggest that the board reconsider if there's some of the disclosures that can be excluded. especially when you compare it to the standard or proposed standard we just discussed in the first topic, where we will add more information on what are the purpose, what are the strategy, and how the different areas are managed. As that will come into each of the standards in the future, I'm pretty sure that this will also somehow flow into this. That might bring us back to, let's say, 180, 200 set of disclosures that have to be at least considered, if not all included, in a non-listed company. I think that is quite extensive, and my suggestion would be that you consider that carefully to see if you could bring it even further down. The advantage would be that for companies that do have some kind of interest locally, they can always act back due to materiality. That will be easier to do than for a lot of companies to scale down from what is proposed right now.
Thank you, Tina. So clearly an ask to go further in terms of reduction of disclosures, or at least look more carefully on them, and also to expand the scope. I think those were at least two key messages on top of the fact that it seems beneficial. Kim, do the auditors feel the same?
I think we do. But let me start by saying that I think I was on board in 2008 or 2009 when we had the IFRS for SME. I was on board that we had an opportunity for other companies than listed companies to use IFRS as recognition and measurement. Unfortunately, we were never given the opportunity to use it in Denmark due to discussions in the EU whether it would require the directive or fulfill the directive or not. So we haven't had the opportunity for a lot of years. So I think we were on board already there. So from my perspective, yeah, go this way, all you can. We can discuss the level of disclosures. How many do we start at IFRS for SME level, or do we take out more disclosures? But I think you should develop this, because today what actually happens is that, at least from a Danish perspective, I know Tina is also talking about subsidiaries in other countries, but what I see from Danish entities or Danish subsidiaries is that they all prepare their financials under local GAAP. So they just use local GAAP. They do not even consider using IFRS because it is way too burdensome for them to use that in the subsidiaries. So I think we need something else here, because having the same set of recognition and measurement rules would allow us to help entities a lot. But the disclosures are way too burdensome in full IFRS. So that's why we look to IFRS for SME, never had the opportunity. So I welcome this project. But I think as a starting point, I think the IFRS for SME standard is a good starting point. Is it enough? I don't know. We will have to discuss that. Regarding the scope, I think you should consider whether it should only be joint ventures and associates, because why joint ventures and associates? Should we even consider that if the entity is without public accountability, then we can use this standard? So it's a matter of where to actually set the scope. Is it just for companies that are totally without accountability, or does it have to be subsidiaries? Does it have to be associates or joint ventures or something else in that situation? Where can we set the bar, and what would be applicable in this situation? Of course, I know we can have some discussions with entities, let's say that's been bought by a foundation or something that wants to go listed in a couple of years, but they can, if they are going that way, voluntarily use full IFRS in that situation. So I think, are there a need to make it even more usable for even more companies around the world?
Thank you, Kim. So clearly an issue about that we would have loved to start using the IFRS for SMEs when that came around, but that we were not able to due to legislation. Thomas, do you have any reactions or further input to this?
I very much agree with Tina and Kim here. And Tina said most of it. We have to remember for a group, it's simply a cost-benefit analysis we're doing here. So if we can work with recognition and measurement criteria according to IFRS, that they are already preparing for consolidated purposes, and we don't have to have a parallel bookkeeping for local GAAP. That would make things much easier. Furthermore, if a lot of countries allows for this, then it would be easier to set up an efficient process for preparing local accounts, because we are not dependent on people in individual countries. We can pool it together in shared service centers, so that would also make things much easier. The number of disclosure requirements, I mean, we could live with a few additional disclosure requirements, but simply saying that whatever is in IFRS for SME of disclosure requirements is automatically moved over here or something similar, I think that would be overkill, because IFRS for SME has somewhat different purpose, as it should also accommodate for individual businesses that has to prepare some sort of accounts. For our subsidiaries, they are included in the consolidated accounts. This is just an administrative burden, and we want to get around it as easy as possible. There is close to zero information value of the individual entities' separate accounts, since everything is under common control, so management can move things around as they wish. The only interesting thing here is the consolidated accounts. And then I suggest you should consider whether it would be possible to use similar rules for the parent company's separate accounts, because right now many listed companies, at least in Denmark, they use Danish GAAP for the parent company's accounts, simply because the disclosure requirements in IFRS is too big, and nobody seems to really be interested in all these notes.
Thank you, Thomas. That was also very insightful. Before handing the floor back to Bruce or Michelle for reaction, we are going to launch the next poll shortly, so the Danish audience at least have to prepare, and it will be open for a while, so you don't have to rush to it. But Bruce, I'll ask you first, and then you can see whether it's you or Michelle. But any reactions to what came out of the panel? I mean, we welcome the approach, the issue about usability in Europe, the expansion of scope. I suppose some of those questions are already familiar to you.
Yeah, thanks very much. I mean, the starting point, of course, is that it's fantastic to hear that the direction of travel is in the right way. And I think that's consistent with what we're hearing almost globally. Many preparers asking us why we weren't doing this 10 years ago. So I think that we're definitely seeing a lot of people very positive in terms of where we're going. I think what I'll do is let me address the scoping issue to start with. This is probably the most controversial issue we're constantly facing at the moment. It's for those of you who would have listened into the board meetings, you would have remembered that we had a lot of debate to this at the board table. As you can appreciate, many people are questioning where the scope is. And I think that to start off with, there needs to be an understanding that it seems to be the feedback on scoping also seems to be very jurisdictional, because it depends, of course, on what your country allows, whether you've adopted the SMEs. So it depends naturally on where they are. Just a couple of comments, and I have to stress that these are my comments, because as you'd appreciate, these are not everybody's views, and you can see that from the alternative view that Francois had already put into the exposure draft. The starting point is why I would be a little bit concerned at this stage about extending the scope is, I think number one is I do get concerned about it creating some sort of confusion in the market. You know, as it stands, we have IFRS, which to me is the gold standard. That is what people apply. You're publicly accountable. You're a listed entity potentially. This is the gold standard of what we do. And then there is the SME standard. So acknowledging we already have two tiers within our financial reporting framework. This standard was developed, this exposure draft was developed on the basis of saying, well, where we have a subsidiary that is still part of a reporting group. So we still have an ultimate holding company preparing full IFRS financial statements. So we believe that that gold standard is still applied within the group. We'll give the disclosure exemptions at the bottom. But they are still part of this group where they're falling into that reporting. My concern about splitting that out and saying, well, hang on, now we'll just allow it for somebody else, means that if I'm somebody who potentially could be an SME IFRS for SME reporter, now I'm kind of reporting under full IFRS, but not really. Well, is that IFRS light? If I'm just a standalone entity, not part of a group, are there disclosures that we've seen would have been part of group disclosures, therefore we've taken them out of the standard, that now aren't going to be available? And I do think that there'd be a big education element about explaining why now there's different type of IFRS potentially within groups where there isn't an ultimate parent producing full IFRS. So I do get concerned that we could end up diluting full IFRS by introducing an additional tier of reporting within that. As I mentioned earlier, I also think that, remember that when we look at these disclosures, one of the safety nets we've used is that we still have that ultimate parent producing full IFRSs. And I think if we have a different approach where the mindset now is that we're not going to look at a company as if all the disclosures are in the group, but now we're looking at it as an individual company, we may need to relook at some of the disclosures that potentially aren't there. So that does concern me a bit. Thirdly, I think the one thing people need to realize, and maybe for countries who haven't adopted IFRS for SMEs, they don't fully appreciate, the biggest value, if you ask a preparer of the IFRS for SME standard, is that standard is only updated every 5 years, which means they've got a fantastic stable platform that when they go through a change under IFRS for SMEs, they do not need to worry about it for another 5 years. And that's gold to preparers. I'm sure any of you preparing under full IFRS will know the last 5 years have been massively turbulent with all the new standards. SME preparers have not seen that because they haven't had that. Sure, we're now going through an update to the IFRS for SME standard, and there's a bit of alignment happening in that. But once we've done the update now, they'll have 5 years of stability. So I think when you speak to preparers, just ensure that they clearly understand that difference, that this standard will continue to change every time we change a full IFRS standard, whereas you won't have that with the SME standard. So there is a fundamental difference in terms of those. The other thing I wanted to say is I do think this is becoming controversial, and my view is I think we should put this out at the moment applicable to SMEs, to subsidiaries, and let's see how it works. If we find in the PIR 2 years down the line that clearly there's a need to extend the scope, we have the ability to do that. But what's worrying me at the moment is if we start worrying now about, well, what if it's a standalone framework? What if it's now associates, joint ventures, and we try and include that too much? I really believe this could end up delaying this project substantially. And I think that for preparers out there who are seeing a huge value in it, I get worried that we could kind of start worrying about everything else and not the primary reason we did this, which was necessarily to give subsidiaries relief. So I do think that's something we should take into account. So, I mean, my view is I'm not saying we would never extend the scope. I just think at the moment, let's just get this out the door. Let's get it there and get that value there for people. And then if we find later in the PIR that actually there is a need to do it, we could do that. On the other question on the disclosures and whether we need more or less, I'm going to hand over to Michelle, who can comment on that.
So thank you, Bruce. Yeah, and I agree on the scope. I think it's best to get this standard out. I do think it's important to remember that the IFRS for SMEs is designed for SMEs, and one of the points that we hear about the IFRS for SMEs is the accessibility of that standard. You know, that standard is probably not much longer than the exposure draft for this project. And that is really important to SME preparers who have limited resources. And I think what we see with the group with this exposure draft is this would be, as Bruce said, a subsidiary that is already applying the gold standard. So there's a bit difference there. In terms of the disclosures, first of all, we didn't just take the IFRS for SMEs disclosures. I can honestly say that we looked at every single disclosure that was in the IFRS for SME standard, and we compared it back to IFRS. And so there was a huge amount of detailed work that went on. Actually, just before Bruce joined the board, so he was lucky that he didn't get to review some of the detailed schedules that we asked people to the board members to review. I kind of hear what people are saying about the length of the disclosures. I guess for us, it would be really good in the exposure drafts to hear where there are more disclosures that are being proposed in this exposure draft than would be in your local gap. And where the areas are that we could maybe reduce the disclosures further. Those would be the important points. I mean, we have done some outreach with users, and we have heard from users who are looking at group financial statements that they will go to subsidiaries' financial statements to try and verify something that's in the group financial statements. So this seems to be the reason that subsidiaries' financial statements. So I was talking to somebody yesterday, and he was saying if he's got a global group and they're saying X is happening in a particular jurisdiction, he will go and find those financial statements for the subsidiary in that jurisdiction and try and verify back the information. And so it is important that we find a balance of disclosures.
Thank you, Michelle. One question, and that's probably more to you, Galina, because I think Kim mentioned the fact that the SME standard could not be used, for instance, in Denmark, and I suppose that goes for a number of countries within Europe, since we are operating under the same accounting directive. Have you considered on the EFRAG side how this would flow with the accounting directive further that the endorsement process that was suggested? I mean, the standard would, as I understand, sit under full IFRS, so it would be a normal endorsement. Would that automatically make it applicable in the EU, or is that something you have considered?
For the moment, we started to considering that, and we already published a survey asking also our constituents to reply to those questions exactly if they see in their particular jurisdictions the interactions between the European directive, accounting directive, and the proposed standards and the requirements of the standards. And it depends really on jurisdiction, because some jurisdictions, like for example Portugal, they allow the use of IFRS and the individual financial statements, and they even can use them after for the tax purposes with some small adjustments. However, in other jurisdictions, it's the other way around, and the local GAAP should be used. And also it relates to the tax purposes. So for the moment, we are at the initial stage of this consideration, but we think it's very important to know where we are in Europe compared to it, because there is also a point that accounting directive prescribes the minimum disclosure requirements. And if those minimum disclosure requirements, for example, in this draft standards are less, then there is a contradiction also. So it's a complicated issue, and the same as also for endorsement, but now we're at the beginning of this process.
Thank you. I take it, Michelle, you also have a comment on this?
Yeah, because I just want to be clear, this would be an IFRS standard, and what's in this standard is the recognition and measurement of full IFRS, which is obviously been endorsed and through the endorsement process, and then the disclosure requirements that are in this standard come from IFRS standards, and even though some of them we've picked up from the IFRS for SME standard, they originally came from IFRS standards, because the SME standard is a reduced disclosure framework from IFRS standards. So I can see that maybe there might be something in the accounting directive that is required, but isn't required in IFRS standards and is therefore not required in this standard. But that's the only complication I could see.
Thank you. And as far as I understood, Galina as well, it's also an issue around whether the member states in this particular instance have chosen to allow the individual companies to report under IFRS, or whether it's only available for listed entities or public interest entities. So I think, but I think that was a good point just to ensure that we covered that. One quick other question, I'm not sure that we, I mean, there's the discussion on scope. There's a discussion on scope within those that those entities that are consolidated, and then there's the issue of scope sort of outside. So if you just limit to the companies within the group accounts, so you will have the consolidated accounts using IFRS. And I think you alluded to that, Tina. Maybe there is a subset of entities that you can't see covered currently that you would like to have covered. Is that correct?
Currently, the proposal includes all subsidiaries. And of course, you have the within the EU, outside the EU discussion that we just touched on. And for us, it would be important that we can apply the standard to subsidiaries both within and outside Europe. There's a number of countries that are automatically applying IFRS in their local gaps. And there it would be, as Thomas also described, it would be a significant help in terms of driving the businesses that we can use it in the same way. But a lot of those entities might be structured in different ways, and it might not be a subsidiary in terms of how we account for it, but it might be an entity where we are still involved in how we are managing the business day-to-day operationally. So now not talking about the management in terms of determining control, but more how we are making the daily operations work. It would be so helpful if we can get those in as well. And that was why I actually wanted to expand it to both associates and joint ventures, because there might not be any interest in those entities from anyone outside, maybe two joint venture owners that are both listed. So why should that entity, just because of the ownership structure, be required to have full IFRS rather than to be within this standard? So I really think we need to consider expanding the scope.
Thank you. And I think we also have the results of the polls on question 1 and question 2. I don't know whether we can bring them up. Because there is, I would say, a fairly broad agreement that the proposal as such would create a reduction in terms of costs. There's also seemed to be a overweight of respondents saying that it will also allow more entities to use IFRS, which I think is very helpful. Still, a quarter of the audience is saying that they do not expect benefits in their jurisdictions. And if we look on the scope, which we are currently discussing, there seems to be an overweight of people saying that scope should be widened to include all entities without public accountability. So that would probably be the minority view expressed in the draft, but just circling back, and I don't know whether that is to you, Bruce, or Michelle, or on the comment from Tina. I mean, we discussed whether should we go for the very broad scope or not, and the narrower scope, saying that Tina argued for, would that? How do you see that sort of more narrow in terms of it? Ensuring that in this instance, for instance, the consolidation and financial statement processes could be simplified in groups, even though they are not fully consolidated. How would you see that? I think you're muted, Bruce or Michelle. I don't know whether one of you would respond to that.
We did discuss with the board extending the scope discussions to include joint ventures and associates. But as Bruce said earlier, the board decided, it was better to get this standard out at the moment. I mean, I think what would be important for us would be to understand the benefits of those that these proposals would bring to those entities.
But I think what we're looking at it from different terms, because we do not have IFRS for SME as an option in Denmark. So at least that's not an option for us. So we are looking from a perspective of using either Danish GAAP or using full IFRS in this situation. So I think we have to leave IFRS for SMEs out, at least currently. It might be an option in the future. We might be able to get the regulators to say that we can use it, but currently it's not an option. So we are standing with either local GAAP or full IFRS. So I think that's why we are pushing a little bit here, because we are saying that this would be better than local GAAP, and it would also be better than full IFRS because it's more easy to and less burdensome to use than full IFRS. So it's kind of an improvement towards local GAAP, and I fully understand that you said, could we make say how many disclosures do we have under local GAAP and how many disclosures would this lead to? But I can say, if Tina has counted right, it is more or less, it's less than 50 disclosures under local GAAP, where Tina counted 180 disclosures in this standard. So for us, it's kind of an improvement for these entities, and it makes, if the entity says it makes it a lot easier for them to use. That's why we're talking a little bit broader here.
Can I ask a couple of questions? Because I mean, I guess. Sure. Sorry, I was just going to say, I mean, I appreciate what you're saying, and I guess this is where the challenge, as I mentioned earlier, comes in, and that when you're global standard set at different regions, where we speak to regions who are using the SMEs, they have a slightly different view. I guess one of the things I was curious to ask was, for your local GAAP, how often do you update that?
Currently, it's smaller updates once a year, maybe a second year or something like that, and the second year. So it's smaller updates if something happens, but yeah, not that often. I don't think that's the biggest problem here, that it gets updated, because I don't know how many updates we would expect. Currently, the IFRS updates for full IFRS is not that burdensome as I see it these years, after we have had the newer standards a couple of years ago. So I don't know whether that's so burdensome, this update process, at least currently.
I think also, Kim, I might just add that normally when there are updates to the Danish Financial Statement Act, it is in the direction of simplification to cater for the smaller entities. So, but the last update where the regulator actually accepted that, for instance, we could also use, for interpretation of the Danish law, we could use IFRS 9 and not fully IFRS 9, but part of it, the expected credit loss model, and IFRS 15 and IFRS 16, which was a big help to those subsidiaries that reports within a group, that they could have the same recognition and measurement criteria in their own financial statement as they have in the internal reporting to the parent company. And this is also where, so I just, while I have the word, I'll say I like Bruce, I'm also very interested in this and excited about this, because I think it fulfills what we have spoken about even when the SME standard was published first, because of course there are some benefits to that in countries where they need a stable platform, as Bruce mentioned, but also we here in Denmark are in a situation where the Danish legislature, they are quite open to see that whenever they can put in options in the law that allows to use IFRS for interpretation, but voluntary, so you don't have to. You can still apply Danish GAAP, and it is not dragging you through the back door into a full IFRS. I think it gives those that are interested in presenting in accordance with IFRS recognition and measurement very wide possibilities. Of course, the possibilities, they still have to be within in compliance with the European Accounting Directive, of course, because otherwise we get trouble elsewhere in the system. But doing that and then completing it with the reduced disclosure as you propose in this one, I think this is at least what we have hoped for. Then I'm not saying by that it's fully the perfect standard yet. There are still some things we need to discuss.
Thank you, Jan Peter. I think we will launch the final polling shortly. Do you have any reaction to that, Michelle? I don't know whether we lost Bruce. Are you back again, Bruce? I can see you. Any reactions to those comments?
Apologies, Michelle, I have to take it. I got kicked out, so I've only just got back in. So,
so I think what I'm hearing is where you've got associates and joint ventures that are required to report using IFRS recognition and measurement, the proposals in this exposure draft would be cost beneficial, and the board should. Oh, I think I was on mute. I apologise. So I think what I'm hearing is if you've got associates and joint ventures that are reporting using IFRS standards, this extending the scope in the exposure draft would be cost beneficial, and that's an area for the board to reconsider in its redeliberations.
Perfect, thank you.
Yeah, and just actually, I've got to say something before, but I think what you said, Michelle, about having some educational material is also very valuable to try. And I know, of course, again, for you, it's also a balance that if you have something educational material, you have to be sure that it's not just an inspiration that is so inspirational that everybody just copies what is in your educational material. That is the same issue we have with the model IFRS financial statements that some companies just take what is in the IFRS financial statement, model financial statement, without thinking that it maybe needs some changes to cater for the entity-specific circumstances. I think you, of course, run into the same considerations when you prepare educational material. But that said, I still think it's very valuable to actually try and say this is what was the thinking behind the project.
Could I just add one comment? Don't misunderstand us. We are really looking forward to the standard. We are just challenging the scope a little bit. So please continue. We are welcoming it. It's the right direction and all that stuff. But we are just challenging whether we could go even further in this, because we actually have been waiting 10, 15 years for something like this to happen, because we haven't had the opportunity to use IFRS SME, at least in Denmark.
And thank you for that comment. Just moving slightly on, and then I'll hand the floor over to you so you can respond to this, but also maybe the final topic, because there's also the issue about what should be the starting point for the standard. We've discussed quite extensively the scope, but the starting point, I think, is equally important. Tina, do you have any reactions or comments to the starting point?
Yeah, as we've discussed a number of times already, or alluded to this, that the starting point has been the SME standard. And I'm not sure if that is the right place to start. Since the SME standard has been developed to cater for groups that are not listed, to allow them to get into the area of IFRS and close to the same kind of set of financials as for listed companies and groups. Now we are looking at subsidiaries that are already being reported as part of a consolidated set of financials under the full IFRS. I'm not sure it's the right thing to start with the SME, because that's sort of in between. And as I said in my opening remarks, I would suggest that you actually look through all of the disclosures in the individual standards on its own, saying what will be needed when investors look through subsidiary financial reporting, with the caveat of those being designed by what activities they have as part of a larger group and not as a standalone group, and then design the disclosures based on what is then needed for those kind of entities, because the purpose of them and the need for those that actually read through those kind of financials are, in my view, very different to those that read through annual reports disclosed under the SME standard.
So the starting point is at least being contested, I suppose, based on the fact that the users of the reporting are significantly different between the users of the SMEs, also the readers of the reports generated by the SME standard, and the users of the financial statements from subsidiaries, since they have the consolidated financial statements. Any reaction from either you, Bruce, or Michelle?
I mean, I guess I'll comment quickly from my side, then Michelle can come in. I mean, just the starting point is you have to have a starting point somewhere. And I think remember that the history behind the SME standard was that we had taken the IFRS disclosures and had amended them to say, well, if they weren't publicly accountable, and if you weren't holding assets in a fiduciary capacity, what disclosures would we then want? So we've kind of already done that exercise on a number of the stands, if you actually think about it. So the SME disclosures were really a result of having applied that thinking and applying the thinking that we spoke about in the BCT 157. So it would be an interesting exercise, and I guess we haven't done this. It would be an interesting exercise to say, well, if we went and did the same exercise on a full standard, would we actually get a very different answer? And I'm not convinced we would get a different answer to what we had in the SME standard to start with. So I think that is a fair point. I guess the other side I'm going to say is it's great to get feedback on that. And if you do think, for example, that had we applied a different approach, we would have got different disclosures that you believe we've left out that are vital to this type of a company, any example of that would be absolutely fantastic for us to see, because I think that would help then illustrate to us that maybe there is some refining we need to do to the approach. So yeah, so any example of that, if you're doing any field testing, you pick up on those, that would be fantastic.
Yeah, and from my side, I agree with what Bruce is saying, and I think it's important to remember that when we develop the IFRS for SME standard, and at the moment we're going through a review of that standard, we've gone back and we've looked at the principles that the board used to reduce the disclosure requirements. So we have gone back to users and said, when we're writing disclosure requirements for SMEs, are these the correct things that you look at? And when we were doing that outreach last year, we did say we are also developing this subsidiaries exposure draft. Do you look for something different in subsidiaries? And the feedback we got was not. These were the right principles. And I think if we were to do as you were suggesting, the important thing that we'd have to do, or the board would have to do, is to work out what are the right principles for it to start reducing disclosure requirements. And we just felt that the SMEs, the board had already done that work and identified those principles. And that's why it was important that we use those principles.
Thank you very much, Michelle. Time is ticking away. So I don't know, Galina, do you have any reactions to this, and maybe also some overarching remarks on this? I can see we're still working on the results of the polling, but any comments on this on your side, Galina?
On the EFRAG side, we agree with the approach of the IASB to develop the disclosure requirements. We think that it's a reasonable approach, and it builds up on what already has been done and identified, and that the disclosure needs remain virtually the same. But of course, we always say, I mean, for the determination of disclosure requirements, for the determination of what is relevant for users, there is always room for subjectivity and for interpretation. And of course, it's never black and white. That's why for example, we propose some additional disclosures to the disclosures already identified by the IASB. But I agree that it probably can be the other way around. And that's why we're waiting for the responses. It's very important to get the responses from the constituents on their views on it. And that's what I wanted to add.
Thank you, Galina. We just received one question, namely, if the subsidiary is a large undertaking, how can the SME standard disclosures be an appropriate starting point? I suppose reflecting from a Danish context, what we saw from the SME standard, and I can always be corrected by my panelists, is that the SME standard would actually reflect the accounting requirements for a large entity in Denmark, if I'm not mistaken. I can see you nodding, Tina.
It would, yeah.
So in essence, you could ask whether SME is the right phrasing of it, or whether it's actually IFRS for large unlisted entities. that might be a little bit more provocative. If we look on the results of the polling, in terms of whether we foresee any incompatibilities, I suppose the majority is saying that we need to reflect further on this, which I think is fair. And going onwards to the next one, whether it should be based on SME standard or the starting point should be IFRS for the cost benefit. At least on the ones voting, there seems to be a preference for taking the IFRS standards for the reduced cost benefit basis. But I think we just discussed that topic. So I suppose with that, I will first ask EFRAG but are there any further remarks in the panel? Then I will ask EFRAG to see whether they have any final remarks on this before I hand over to the IASB. Any concluding remarks? Chiara, I can see you also. Okay,
no, I think it was complete from our side. Thanks a lot.
Thank you. Then I will hand over to IASB first for the concluding remark on this, but also for a very short update, given the time on a few other projects. So Bruce, I'll hand the floor over to you.
Thanks very much. And just to conclude on this project, we really appreciate the feedback from everybody. I think it's going to be good to get the feedback from your stakeholders, and then we can feed that into our discussions as we move along. Just moving on to the last two, and I am very conscious of the time at the moment. There were just two projects we were asked to take a quick look at to give an update on, being the agenda consultation and the management commentary. We had some slides. I don't know if they could, staff could put those up for us. Great. So just starting off with the agenda consultation. Very briefly from our side, in March this year, remember, we launched our third agenda consultation. Now, the objective of the agenda consultation is obviously to seek views on the strategic direction and the balance of the board's activities, the criteria for assessing the priority of financial reporting issues that could be added to our agenda, and any new financial reporting issues that we should be giving some form of priority to. What we did effectively is we asked, in doing this agenda consultation, we asked for comments really in three areas. Number one, on the right-hand side of the slide, asking about the strategic direction and the balance of the IASB's activities. Now, you can see in the red, those are the four activities that we normally undertake. By the way, they're not to scale. But the question is, do you think it's right? So do you think we should be spending more time on maintenance of persist application, more time on digital reporting, just to get a sense in terms of where we were and how much time we're spending on each area? The second then is we'd come up with criteria for assessing whether we should put something onto our agenda. And we are asking for comment on whether we believe those criteria were correct. And then the third area we asked for was we had some items that we'd picked up in terms of our various consultations as priority areas that we should potentially be looking at to add to our work plan. And we were asking people to give us an idea of where they think we should be doing, which of those should be a priority, and also an indication of how much work we should do. So, for example, on some of the projects like intangible assets is a very popular one. How much work should we be doing on that? Things like cryptocurrencies. So, for example, we've asked, should we be doing an entire completely different standard on cryptocurrencies, all the way down to should we just be doing something on disclosure or education material? So really asking on some of these key things that we've heard a lot of messages on, should we be doing more on those or less on those? And of course, are there any other projects, as I mentioned earlier, that we haven't heard anything about? Now, the comment period closed at the end of September. And of course, now is when the real work starts, where we start analyzing the feedback we've received with the aim of publishing a statement in around Q2 next year. I think it is just to talk a bit about about what will be the key areas for us to do over the next 5 years. Always remember, last thing I want to mention with the agenda consultation is once we set that agenda, things can be added to it where there are items that come up that we hadn't anticipated. So, for example, we've dealt with things like IBOR reform that wasn't anticipated. We've had to deal with the COVID crisis where we did amendments to IFRS 16 on leases. So we're always going to pick up areas or narrow scope amendments that as need to be done. But this is really where we can't set the longer term key objectives. So that's just a brief update on where we are on the agenda consultation. I think I'm going to hand over to the EFRAG team, who's just going to give us an update on their views on that.
Well, I don't know if we have enough time for this. If I can just briefly say that we have 6 topics that are a priority. The first is connecting financial sustainability reporting starting from climate. Crypto assets, intangibles, and variable and contingent, where we already have research ongoing and we hope to influence the IASB, and discontinued operations and disposal group, and statement of cash flows and related matters. But I don't want to take time from the others that want to do the takeaway and close the event. So I think just the last remark from my side. Thanks a lot for joining forces with us on this outreach event. Looking forward for your comment letters on the management commentary practice statements, where we still have the consultation open until November. Over to you for the closing.
Thank you very much for that, and also thank you on our side. I will hand over now the floor to Jan Petter to do the final remarks and the main takeaways. So
yeah.
Jan,
thank you, Kristian. Yeah, so first of all, thank you to all that attended this, both from the IASB and EFRAG side, and also the panel for some interesting discussions, I think, actually, and hopefully some input that you can consider in your further deliberations on this. I think what I took away from this, and you may correct me if I misheard, but I think I heard that people in general think that you are on the direction of travel is right. That is not to say that there are no comments, because I think you understood this in the famous Danish blunt way, that there are some things that maybe we would like to ask if you could consider that as well. But I think altogether we are on the right track with both these projects from the Danish point of view, and so we look very much forward to see what is coming next on the exposure drafts on this, and then of course the final standards.
So I think with that, we are through for today. So thank you very much, and welcome back to a future event. And thank you to our co-host, EFRAG and IASB, for joining in today. So thank you very much, and see you next time. Bye.